Traders ask, how high and how fast? Shifting goals, Russia looks to annex occupied Ukraine, narrowing its objectives. The EU's von der Leyen announces further sanction plans. Plus, heavy Lyft, the ride-sharing giant craters after plans to boost spending on driver incentives.
Tom, let's take a look at the futures. Now, two interesting developments. Of course, it's all about the Fed, how aggressive the Fed positioning going forward will hike. If you look at Fed futures, or certainly what traders are expecting now, 3 hikes, 50 basis points for the next 3 meetings. Maybe we talk about 75 basis points. The FTSE pretty much flat, the DAX pretty much flat. If you look at the oil embargo that the president of the commission was just talking about, are we going to start to have to ration? And that's $1 million question out there.
And this on a week when OPEC Plus meets, of course, as well. So we'll be checking the oil price. But as you say, when it comes to the Fed, will 50 basis points actually be taken as dovish by the markets? Given what we saw from the RBA, of course, that surprise increase in hikes above the estimates from Australia, will the Fed and will Jay Powell also open the door and keep the door open to 75 basis points? Those are the near-term questions when it comes to that press conference. The longer-term question, of course, of the Fed is whether they can actually engineer a soft landing amid, of course, concerns about the inflationary pressures. Let's check in then on these markets here in Europe. You're seeing modest gains of 0.2% over in Spain. You saw gains yesterday, by the way, in the European session, and a very modest upside picture on Wall Street. So the handoff is there, but of course with that volatility and uncertainty when it comes to the central bank action. The CAC currently is gaining 0.2%, and you're essentially range bound here in the UK on the FTSE 100. Let's switch things over and see how things are playing asset by asset then, particularly with that focus not just on the futures, but also on the Bloomberg Dollar Index at those 2-year highs, and then the question of oil. So the S&P E-mini is pointing to gains of 0.2%. Of course, much of that will contingent on what we hear from Jay Powell. The US 10-year currently at 2.96, so below that 3% level, but you could get there, of course, depending on whether or not we see a more hawkish Jay Powell. And then there's the Bloomberg Dollar Index, currently range-bound as well, but of course the strength for the greenback has been very pronounced at 2-year highs. This is where we're focused, particularly today, on the back of those comments from the EU's von der Leyen saying there is now a proposal to ban, in a gradual pace, Russian oil into the European Union. Currently at 107, you're seeing gains of 2% for Brent. Francine.
Yeah, I did call it an oil embargo. It's not an oil embargo. It's an oil embargo for the next 6 months, but still it could be quite a big shift. So if you look at the sectors, if we dig deeper into them, so overall 18 sectors, I have about 10 on the upside, Tom. They're not huge moves, but they're gaining between 0.1 and 0.6%. Media, travel and leisure, banks, energy on the up. On the downside, I'm seeing a little bit of pressure for retail, technology, food and beverage, for example, but earnings overall, and we spoke to 2 chief executives earlier, Equinor, but also Pandora, you know, they do the sterling silver bracelets. They actually came out with some pretty strong earnings, good visibility, and those share prices are up.
And across the board, generally, what you're getting is a relatively positive picture, as you say, when it comes to the earnings front. And the focus for many analysts and investors is ensuring that you focus on those corporates that have the margin and the pass-through when it comes to costs. And as you say, Equinor, one of those companies, of course, the input costs, but also the output costs. Of course, they're producing oil and energy, Norway's biggest producer of energy. And they're coming out, of course, with the top line very positive indeed. You're seeing pressure, though, on the stock, down 2%, despite the fact that they came out with results that, of course, beat on the back of those high energy prices. Aston Martin, you've had a change at the top here for, of course, the UK luxury car maker, the supercar maker. The CEO stepping down, being replaced by the former CEO of Ferrari. They're in the middle of a change-around plan at that company. Investors liking that move, up 2%. And when it comes to Sberbank, this was also part of the announcement from the EU's Commission President, gaining 2% despite the fact she's come out and say they will be banned and blocked from SWIFT. Francine.
Yeah, so let's get back to that breaking news that you were just mentioning, Tom, on Russian sanctions. Bloomberg's Europe correspondent Maria Tadeo is in Germany. Maria, it feels like phasing out Russian oil and gas in the next 6 months is actually a quite aggressive move from the Commission.
Yes, Francina, we have that confirmation of that new package. The idea is that it's going to be proposed today, and then, of course, it's up to the member states to approve it. But the idea is that this will be approved by the end of the week. And you heard it from the head of the Commission. Vladimir Putin has to pay a price, and it will be a heavy price. This is, in many ways, an embargo, a light form of an embargo, because there is a 6 to 8 month transition period for refined and crude. The other thing, Francina, a source now telling me that this package, von der Leyen did not mention this, but this is a key detail, and I want to stress it, that this package will also include a special regime for Hungary and Slovakia to get it through the line. Remember, at one point, Viktor Orban had suggested he would not approve an embargo because it would be detrimental to his economy. So what I hear is that this will also include now a carve-out for the Hungarians.
Okay, so that's how you deal with some of the divisions within Europe then, Maria. Arguably, the cynics will say, look, oil is the easy part of the energy complex. What about gas?
Yeah, look, and you could argue that gas is a big geopolitical weapon. When you look at a country like this one, Germany, by the way, the German government is meeting here right behind me, where you see this castle. It's a special retreat they're doing, perhaps a little bit of soul searching for Germany when it comes to their dependency on Russia. But Tom, you know, I wouldn't undermine the significance of this move either, because we know that oil is the moneymaker for Vladimir Putin. A lot of this will have an impact on Russians' finances. Yes, you're right. Gas is still a bigger issue for a number of countries, but oil continues to make a lot of money for the Russians. So this will have an impact, and of course, I'm pretty sure the Russians will put out a response today to this. Vladimir Putin, by the way, had already hinted that Russia would take countermeasures to the unfriendly countries that continue to target what he says is an unfair operation from the West.
Maria, thank you so much. Maria Tadeo there live in Messberg in Germany for us. And now let's get into the key market drivers with our markets editor, Christine Aquino. Christine, interesting timing. The EU proposing, of course, this phase out of Russian oil by the end of the year on Fed Day, where we're already worried about inflation and interest rates will go up.
Absolutely, Francine. And I think that really just adds to the anxiety about overall inflation in the economy, whether that's coming from the price of goods and services or, in this case, the price of commodities like oil. It's interesting, though, because now that we're getting these headlines from the EU, it's not necessarily creating an immediate impact on the oil price. Brent, yes, is elevated today, but not within the recent ranges, and actually still down from the highs that we saw earlier this year when Russia first invaded Ukraine. I think for a lot of investors, the big question is whether this proposal can make it through the famous EU red tape and whether it will actually pass in its current form, or, as Maria was alluding to earlier, whether it will have to be watered down and will need to have some carve-outs for various countries.
Brent currently trading at 107, up 2.2%. When it comes to the Fed then, Christine, 50 basis points, is that the hike that comes through from Jay Powell and team? Will that be seen by the markets as dovish?
Well, Tom, I think that is the danger here. If they deliver anything less than 50 basis points, then that would be quite a dovish step, given that Jay Powell and a number of other FOMC officials have already flagged that as nearly a done deal. Of course, now markets are amping the pressure on the Fed and turning their sights to a potential 75 basis point rate hike. We got to about a 50% probability in terms of pricing for that over the last couple of days. The rhetoric doesn't seem to think that that is a possibility today in reality. But of course, it really just shows how much markets have really amped up their hawkish expectations from the Fed and now are expecting policymakers to deliver.
You know what I hear from traders, Christine and Tom, is that actually people don't know how to price inflation. We're speaking to the head of capital markets at Deutsche Bank yesterday. They were saying, look, it's really difficult if you're a chief executive to know what to do with prices. And if you're a young trader, you haven't lived through actually any of this inflation. So my tip of the day, go and speak to the boomer in the office and they'll tell you what it was like in the 80s and 90s. Christine, how much more pressure does it mean for other central banks when they look at this inflationary pressure coming from the Fed?
Oh, Fran, it's immense pressure on other central banks for sure. We saw the RBA, for instance, instance, deliver a bigger than expected rate hike yesterday. And that makes a lot of sense. Australia is an open economy. It's a small economy that really responds to what happens globally. And so the RBA really needed to deliver that surprise to create that impact instead of their markets really more just kind of following the global trend. And it really does raise the pressure as well for the Bank of England, for instance. Meeting immediately after the Fed on Thursday, we're already seeing pricing for a 50 basis point rate hike in September. And so that's really going to be a difficult line for the Bank of England to walk, especially as the UK is still grappling with its worst cost of living crisis in decades.
Okay, Bloomberg's Christina Kino, thank you for walking us through some of the key market themes for us. Joining us now is Paul Donovan. I'm not going to be hitting him with the category of
Not a boomer.
Quite, yes, there's so much more going on with Paul Donovan than that case. Gen X, okay, we'll go with that. Paul Donovan of Gen X, of course, Chief Economist at UBS Global Wealth Management. Paul, we heard from Ken Rogoff yesterday speaking to our US colleagues, of course, former Chief Economist at the IMF, saying the Fed is going to have to raise potentially to 5%. Do you align with that view?
I think that's quite an aggressive call. We're at a situation now where quite clearly I think the risks to growth are greater than the risks of ever higher inflation. We're seeing inflation come down in the details. Inflation peaked in the States in March in all probability. The question is how far and how fast it comes down, not the direction of travel. But the growth risks are there, and we have started to get some hints of this in anecdotal data where companies are saying, actually, you know what, consumers are resisting price increases and they're starting to scale back their demand. And that, of course, is going to be an area that will be increasingly in focus as we progress through this year.
I love our central bankers, but I hope they're not watching today. I almost love central bankers as much as I have economists, Paul. The problem is they're behind the curve. Why not wow the markets with 75 basis points? Let's go and see after.
Because we've got a couple of problems here. The first is that if you shock the market's going to say the Fed knows something we don't, and they're going to start pricing in a lot more aggression. And that could be very, very damaging to things like the property market, which is already reacting to the increase in mortgage rates. And then, of course, if you're hitting the property market, you're hitting furniture, you're hitting the building trade, and it sort of ripples out very, very quickly. So that's your first problem. The second problem is we've got to recognize the quality of economic data has fallen dramatically over the last 4 or 5 years. Well, because basically it's all survey-based and nobody fills in surveys anymore. And we've also got increased political polarization. So, I mean, look at the Michigan data. Democrats tell you it's the best of all best possible worlds, and Republicans tell you it's a complete disaster, worse than the Great Depression. Yeah. So we've got data quality problems, which means you cannot be certain what's going on in real time.
When's the last time you did a survey? 1985.
You get called up by pollsters. Okay, and then you get asked
Sorry, I have dinner
the range of questions. Yeah, of course, you make excuses. I've got the kids' swimming lesson or something. So, yeah, to your point, I mean, it just reminds me, I spent 5 years in China. Of course, the constant conversation is, what is the quality of the data that we're actually getting out of the Chinese officials? So the quality of data across the board is problematic. Of course, a big story for us today is what's happening in the oil complex. And I thought it was interesting, in your notes to us, you suggested actually higher oil doesn't necessarily mean higher inflation. Can you just unpack that for us? As we see Brent up 2% today, 107 a barrel.
So oil has always had two effects. Commodity prices have two effects. There's a price inflation and there's a growth deflation story. Because if I'm spending more money putting diesel into my Land Rover, then I've got less money to spend down the village pub. Yeah. So demand goes down. And interestingly, we've had some hints in the States of the implications of this, where, for example, in last month's consumer price inflation number, fast food prices had the biggest monthly decline in 2 decades. Now, that's food prices. You think, well, food goes up. Well, actually, fast food's got very little to do with food prices. But what's happened, of course, is that as households are feeling that squeeze coming through from energy costs and so on, they're looking to cut back spending elsewhere, and then companies are responding to it. So it's not a clear-cut situation. It's both a price inflation and a growth deflation consequence coming from the commodity price moves.
If I were pessimistic, which of course I'm not, I'd say people are taking advantage of this. I know I'm paying like through the roof for new windows because inflation overall is going up.
Well, I just have this image of you running to KFC, which is a bit disconcerting, as the prices drop there. But we'll look for that. Fast food, there we go. Maybe there's some upside there in the inflation
cappuccinos, espresso espresso.
It's all about the
everything's
cappuccino
going
when it
up.
comes to Francine. The cost of cappuccino, this has been a bugbear for you.
Yeah, this is the new Big Mac index. Paul Donovan, all over the cappuccinos in London. Chief economist at UBS Global Wealth Management, stays with us, and we'll talk about inflationary pressures much more. Coming up, the EU proposing sanctions on Russian oil imports. We'll have more on our top story, of course, throughout the show. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. 15 minutes into European trading day. Bonds falling today. U.S. equity futures, modest gains. So we're seeing the same modest, I guess, fluctuations in European stocks. It's all about the biggest Fed interest rate increase since 2000. And of course, traders across the world waiting for more clues on how aggressively it will tackle inflation. So these markets a bit meh. They're kind of moving sideways.
Yeah, well, when you look at the bond markets, though, there is some movement there, and they sell off continuing. If you just look at the BTPs, for example, yields up 5 basis points on the Italian 10-year, up 5 basis points on the German 10-year, and saw a move up again in Australian yields as well, as investors there continue to digest a more hawkish RBA. And that global bond market sell-off, as I say, has continued to deepen. The asset class is on track to post its worst year ever. Today's Fed decision threatens to jolt the market anew. With more is Danny Berger. Danny, what are you looking for?
I'm looking at this positioning heading into the meeting, Tom. It is very stark polar opposites in terms of real money versus fast money. That is the asset managers versus the hedge funds. The hedge funds have been growing their short position according to the latest CFTC data, perhaps part of the reason, part of the fuel behind the sell-off we've seen. And of course, these long-only asset managers have their long position. Many of them have mandates to hold something here when it comes to the bond market. But the spread between these two have reached the most extreme level since 2020. And considering today's decision, one of these groups could get burnt. Of course, hedge funds have the discretion to act much quicker. So should it not be as hawkish, you could see some short covering here move the market as well. But of course, this is a global bond market, as you alluded to, Tom. We had the RBA decision yesterday, which did its part to push yields higher. So how will the global bond market react to that? We already are seeing German bund yields, those back above 1%. Francine, UK 2-year yields, those are just just under 2%.
Such a good chart, Danny, with the chart of the hour of the day of the week. Danny Berger there with the very latest on what we could see from the Fed. Now, still with us, Paul Donovan, Chief Economist at UBS Global Wealth Management. It's great to talk about inflation. I know it sounds boring, but actually this underpins everything that happens on the markets. I have Owen writing in saying, yeah, a coffee in London is now £3 across the board. But you believe, Paul, that you're looking at indicators, so the prices of TV, where inflation's actually coming down. So this will be short-lived.
Well, so what we had last year, of course, was a phenomenal demand surge. I mean, it was absolutely remarkable because we got this stash of savings acquired during the pandemic. Everyone goes out and spends, and certain goods go up in price really dramatically. But what's happened, of course, is as the savings pot has been spent, we come back to a more normal pattern of savings, but with record supply. Remember, last year there was record supply of goods, record global trade, record manufacturing output, and that supply is still there. And so in certain goods, we are already seeing deflation. Television's case in point, where prices are actually coming down. Now, coffee prices, absolutely going up, and people remember that because it's something you buy every day or every hour in some cases. And so you remember the price going up, and that sort of sticks in the mind. But used car prices substantially lower than they were 6 weeks ago, jewelry prices, televisions, certain consumer electronics. We are seeing prices drop where we would expect them to drop. That's the key point.
What about wages, Paul? And this is remarkable to me. So we just on an anecdotal basis, okay, swimming classes for my 5-year-old, couldn't find any swimming teachers, £35 for 45 minutes. That's what we ended up going for. So that's almost £1 an hour, give or take.
Cheap.
Remarkable.
She better be a swimmer.
Because they couldn't get the staff. What is happening with labour costs? Are you seeing any wage price spiral happening effects? Are you seeing that increase at all? Is it becoming sticky now?
So the important point here is wage cost price spiral, not wage price spiral. Because if you pay people more money because they're working harder, as I repeatedly remind our beloved chief exec, that's not inflationary, that is a good thing if you're paying hardworking economists more money. And if we look around the world, global output is pretty much above pre-pandemic levels in every major economy, but global employment is below pre-pandemic levels. So you've got fewer people producing more stuff. Paying them more money is not automatically inflationary, and that's what we've got to adjust for. And so when we do this and we get the unit labor costs, which is the adjusted number, those are actually within normal ranges. Now, I'm not saying we ignore this. We monitor this very carefully, but I don't think this is necessarily a huge issue. What we are seeing is relative wage changes. So some professions have suddenly become more in demand, long-haul truck drivers, classic case, and you get a one-off increase in wages coming through in order to attract people back into the profession. So you are seeing some relative wage changes.
Okay, but overall, I mean, and we're hearing from Unilever, they're switching from one type of oil to another cooking oil because of what's happening in Ukraine. Unless the war stops tomorrow, and that's highly unlikely, are we just not going to see more and more inflation across the board in Europe? And what does it mean for ECB?
Well, remember, inflation is the change in prices. So, are you saying, actually, we're going to continue to see oil go up 100% a year? Yeah. Are we going to be at, 250 next year and then 500 the year after? And if the answer is no, then that becomes a negative influence for inflation because we're talking about the change, not the level. Right. So that's an important point to bear in mind because as we go through this year, the base effects start to fade. At the moment, when we look at inflation, we're comparing a normal economy with a locked-down economy. And of course, the change is huge. Yeah. But give it 3 months, well, already in the States, 3 months in the UK, 6 months in Europe, you're going to be comparing a normal economy to a normal economy. The year-on-year inflation rate does come down in that situation.
I need to buy a TV just so that I feel like I'm saving money.
Get out there, some bargains to be had, according to Paul Donovan. What I love about Paul Donovan, he takes the top-line numbers and breaks it down, and there's some counterintuitives, or what seem like counterintuitives, within the data, just to give us that context. Always excellent. Paul Donovan, thank you so much.
Last time I bought a TV was like the year 2000, so I don't know whether it'll be cheaper than that. It can't be, right?
It probably will be cheaper than it was in 2000 because you've had deflation for a long period in things like consumer electronics.
There you go.
And it'll be a larger TV now.
TV, the cinema effect in the new home. Francine, okay, Paul Donovan, thank you. Of course, Chief Economist at UBS. We're going to get on to the corporate earnings picture. This is part of the mix, of course, in inflation, input costs as well, certainly in the renewable energy sector. Vestas is forecasting its first loss in a decade. That's after costs related to the wind turbine maker's exit from Russia added to those supply chain problems. The 2022 profit margin will be in range of -5% to 0. That is according to a company statement late on Sunday. Joining us now to discuss the forecast is Henrik Andersen, CEO of Vestas. So thank you for joining us this morning. Let's talk about the supply chain constraints. Where within the supply chain are the pressures most acute, and what is the time frame as to when you expect those pressures to ease?
First of all, thank you and good morning, and thank you for having me on this conversation. I think the supply chain, as we have also said, it's been coming and it's been tight for quite some time, and Q1 just complicated all of that with, of course, the latest Russian-Ukraine conflict, because that just meant that combined with certain lockdowns in China has spread ripple effects again to the weights outside harbors and also to some of the logistics. So I think the transport logistics right now is complicated, to say the least. And at the same time, we also start seeing some of the shortages in certain raw materials and components.
Right. So given the situation in Ukraine and the fact that we have higher power prices, higher natural gas prices, what does it mean for renewables? Is the transition going to take longer, or will it significantly accelerate it?
We jump right up in the air again. Then I will say on the high level here, the energy transition has probably never been more imminent and never reminded anyone what goes to politicians, business leaders, and the likes. Because I think we all have to make an active decision there to get the energy transition move faster. We have been talking about it for a long time, and that definitely has to accelerate, because we somehow need to become more independent on that previous known energy sources like the gas and the oil, etc. I think that's the outlook, but that doesn't change that 2022 is going to be a pretty tough and a pretty difficult year to operate through. But the long-term outlook for the renewable industry has never been better.
Are you getting more inquiries from clients concerned about these higher energy costs? And what are you doing with pricing? Are you continuing to raise prices in the quarters ahead?
I think when we go home tonight and we check our meter back home on the electricity, we know that meter has become more expensive. The electricity prices are at historical high levels in most part of the world, and especially in Europe. So I think for where we see our turbines have gone up now through the last 4 decades, most of those customers that have the output from the turbines have become incredibly more valuable. And we see that from the energy companies, our customers, the utilities. And of course, that part of it is also definitely coping with that there is a increased price on the turbine. And of course, in the individual bilateral discussion with a customer, it's going to be tense because it will be more expensive.
Yeah, the worst idea is to go home and check your meter tonight, because it kind of, raises your blood pressure in like 2.2 seconds. Henrik, how long does it take you to build a turbine? So if there's a new project, and is it regulation that makes it last 2 years? Can you go any faster in putting some of these things online?
I will say on average, if you call me today and you ask for something, you will be able to get it within 3 to 4 months anywhere in the world. And if you then go back and check, I think today the permitting and the application process in many countries takes years. And I think this is where I think we have to make that step change now, because if we can get that step change done in the process and permitting, we can also provide the solution for it.
All right, thank you so much for joining us. Henrik Andersen, they're the Chief Executive Officer of Vestas. Coming up, markets await the Fed. It's expected to raise rates by 50 basis points today. It's the biggest hike since 2000. Just think about that, the biggest hike in 22 years. What does it mean for traders? They've never lived with inflation, Tom. They don't know what to do with it.
Go to the boomers. That's your advice. 75 basis points. Boomers. Is that what's going to be, the door's going to be kept open for that? Yeah, this inflationary picture. Paul Donovan unpacking it for us. Maybe things are starting to come off. We're looking ahead to that next. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. The 75 basis point question: when the Fed says hike, traders ask how high and how fast. Shifting goals: Russia looks to annex occupied Ukraine, narrowing its objectives for the invasion. And a new raft of sanctions. The EU proposes to phase out Russian oil by the end of the year. It also aims to cut off Sberbank and other lenders from SWIFT. Tom, markets, of course, looking at the Fed, but then they look at these new Russian sanctions, and you have to wonder how Putin will react.
Yeah, the oil prices are up this morning on the back of that decision by the European Commission to start that gradual embargo of Russian oil. Gas is a different question. But as you say, you're looking at 50 basis points for that Fed hike. That is the market expectation. And then, of course, the focus switches to the press conference and whether or not Jay Powell leaves the door open to 75 basis points. And, of course, what else he has to say about the balance sheet as well, that $9 trillion Fed balance sheet, the unwind of that as they start to allow some of those assets to roll off, and the time frame, of course. In terms of the markets, they've turned around a bit here in Europe. They're lower now by around 0.3%. Earnings remain in focus as well, with many investors scrutinizing the margins and the abilities for these companies to pass on costs. The DAX is down by 28 points, or 0.2%. Here in the UK, the FTSE 100 lower by close to 0.3%. As we say, the energy complex and oil higher on the back of that European Commission proposal. We're waiting for more details on that. Let's switch focus and see how things are playing out then across these different sectors. A bit of divergence when it comes to sovereign bonds, by the way. You've seen yields come off a little bit when it comes to US Treasuries, but here in Europe, yields are up, certainly in Germany and certainly in Italy as well. Travel and leisure at the top of the list, gaining 0.9%. Media and energy also high. Of course, Brent above $107 a barrel the last time I looked. At the bottom of the list, basic resources lower by 1.4%. Retail, food and beverage also down amongst the sectors that are in red. Again, across the board, you're seeing a little bit of risk off. Just 30 minutes into the session, maybe investors waiting on the sidelines for more clarity when it comes to the Federal Reserve. The Bank of England, of course, coming to play on Thursday. Francine.
Yep, the Bank of England playing on Thursday. Now, in the last hour, the European Commission President Ursula von der Leyen has also proposed an orderly ban on Russian oil imports. Here's what she said.
So today we will propose to ban all Russian oil from Europe. This will be a complete import ban on all Russian oil, seaborne and pipeline, crude and refined.
Bloomberg's Europe correspondent Maria Tadeo joins us now from Germany. Maria, I think at the beginning I misspoke because I was talking about an oil ban with gas, but is that not far off? And would Putin just turn around and say, actually, you know what, I'm selling everything I have in terms of energy to someone else?
Yes, Francine, and this is exclusively when it comes to oil. In many ways, it's a light embargo because you did see that von der Leyen made it clear there is a transition period of 6 to 8 months. And just also very important, if I may very briefly, there will be a special regime for Hungary and Slovakia, potentially all the way to 2023. So they approve this and get this package through the finish line. But Francine, one thing that you mentioned, and this is also key, is that the Europeans are essentially going from coal to oil and potentially gas. So yeah, I think you're very right. There will be a conversation about gas and when this embargo could also potentially go into effect. What I would say is for many Europeans, that would be much harder because oil, the transportation is easier. The gas pipelines, you need the infrastructure. In a country like Germany, they're not ready for that. And if you look at the dependency, this still continues to be a much bigger deal. Yes, oil makes money for Russia, but gas for the Europeans is much harder to replace.
Maria, how is this going to work in practice, the phase out of oil, and what else is coming through in this list of sanctions?
Yeah, and Tom, you saw that reference to this ban for first crude and then another 8 months transition period for refined. That would be or would take us all the way to the end of 2022. We knew that the German industry in particular, by the way, had asked for this in order to be able to adjust. But what's also interesting here, Tom, is that this is not just a ban on Russian imports of oil. It will be a ban also about the services around it. So this means the insurance, it means the cargo ships, it means that European vessels won't be able to touch this, not going to be able to transport this. Any brokerage, financial services around it will also be banned. So it's not just about the primary source here, oil, but also the services around it. And if completed, it would put an end, like I said, to that very huge relationship that Europe's had for decades when it comes to Russia, and a lot of money lost for the regime of Vladimir Putin. Is this going to put an end to the war? Well, that remains to be seen. If you look at the language coming out from the Kremlin, it doesn't suggest they're going to stop anytime soon. If anything, Vladimir Putin will want to declare a full war on Ukraine by the time we get to Victory Day on May 9th.
Maria, thank you so much for the great update. Also, our editor Luke wrote in saying, look, the sanctions on Belarus and potash could also put extra pressure on some of these food prices. So these sanctions will hit specific food groups. Maria Tadeo there, live from Bestberg in Germany. Now, joining us now is Sharon Bell, Senior European Portfolio Strategist at Goldman Sachs. Sharon, thank you as always for joining us. How much more pressure does this put on inflation, and how difficult does it put Europe? Are we looking at a possible recession?
I mean, European inflation is already high single digits. You could easily see some double-digit inflation numbers coming through. And you mentioned food prices, you mentioned oil prices, headline inflation is already very, very high. And this clearly hits people's cost of living. So I think that we're pretty close to recession through this year. If you were to see, for example, you talked about the dependency of Germany on Russian gas as being much, much higher than, say, Russian oil. If you were to see that gas restricted, then there would be a deep recession. We, on balance, think you probably avoid recession, but it's pretty close.
How do you position for that potential reality of a recession? That's your base case. You think you're going to avoid it, but do you need to start positioning now for a potential recession? How are you doing that?
I think a lot of investors are already positioned that way. And if you look at the way, say, cyclical stocks have performed, which, you know, classic ones, industrials, chemicals, some of the consumer cyclicals, etc., they've already underperformed quite a lot this year. You've had more defensive, more staple stuff do well, and obviously commodity sectors as well. So I think a lot of that positioning has already taken place. I mean, for me, I think a great hedge still against higher inflation, weaker economic outcomes too, are still actually commodity sectors. Clearly they'll be hit by lower demand, but these companies have great cash flows, ability to pay dividends, very low payout ratios generally. So I think that's still a very good place to be.
What do you make, Sharon, of what the Fed will do? Is there really a small possibility that they go for 75 basis points just to, put the market kind of in its place, or give them a good signal that they mean business, or would that just be too dangerous?
We think they'd go 50, but clearly there's always a chance that they look to surprise the market, given how much inflation has been surprising on the upside recently. We've had some slightly weaker data recently, like the ISM survey, for example, the Philly Fed survey before that. So maybe that will push them less inclined to do 75, but our view would be 50. We also think that they will announce the start of balance sheet reduction as well at this May meeting. So I think there'll be much to hear in the press conference afterwards, and about the outlook for the next few months. But our best view is 50 for this meeting.
Sharon, at the top line, the European stocks, you're seeing losses of what, about 8% year to date. The FTSE 100 has done better if you carve that one out. What are you thinking about in terms of the broader index and the direction of travel through the rest of this year? Are we starting to bottom out across the benchmark, or is there further pain ahead?
Yeah, I mean, there has been definitely some pain. I completely agree. The broad index down, I think, 8-9%, and that's in euro terms. If you put it in dollar terms, say you're a dollar investor, you're down 20% because the dollar's been so much stronger. So actually, I do think there's been quite a fair amount of pain in the index level, and for good reason. We've just discussed some of these that we're on the brink of recession in many ways. Inflation is incredibly high. Interest rates are going up, all that pain being applied to the market. But I actually think the market is now discounting a weaker growth scenario, not a really deep recession. If that Russia gas was cut off, absolutely the market would have further to fall. But I think a modest downturn is quite well priced, and I would see markets rising modestly from here on the back of some earnings growth over the next couple of years, weaker euro also helping those earnings too, and quite low valuations, particularly versus other assets still.
Sharon, I'm a little bit obsessed with this idea that you have to ration, and so certain sectors will actually be shut down. I was reading, Tom, about, for example, perfume bottle maker that would have to be shut down in Germany because it's just not essential if there's an oil or even gas embargo. So do you sell those sectors that could be hit first?
Yeah, it's a tricky one. I mean, obviously that's not our core view, but investors aren't just interested in core or average scenarios. You've got to think what will be the tail risk, and you're absolutely right. Shutdown of production would be quite a big tail risk. More manufacturing sectors, people that produce in Europe would be hit by that. And again, maybe the best sort of, if you want to go a bit more cyclical, picking up commodity stocks or even banks, which aren't sort of super dependent on manufacturing in Europe, would be more cyclical sectors, which are a little bit defensive against that. And if you want to look at more defensive sectors, that perhaps be more stable in the types of outcomes that you talk about, things like healthcare, not particularly expensive, it's already performed well this year, and not super dependent on those things like manufacturing processes in Europe.
Sharon, when it comes to the China question, of course, the drag from that economy and the read across to European equities, are you and the team actively looking at that exposure? Are you starting to remove and reduce? Would you recommend reducing exposure to, for example, European autos, European luxury, where there is, of course, that big trade?
Yeah, I mean, we're generally underweight most of the European consumer space. Not really because of China so much, but because we think the European consumer will be hit by the things we were discussing before, very high inflation. But you're right, some of those companies also have a lot of exposure to China too. And China is likely to be pretty weak this year. We've been below consensus on China growth through this year. We have 4.5% growth in GDP. There's possibly a bit more downside risk to that, given the lockdowns currently in China. So I definitely think those areas are risky. Of course, as with all things, the market knows this. You've already seen some of these stocks trade down, but I think in the near term, they remain at risk.
Okay, look to defensives. The energy sector has more potential upside. Sharon Bell, Senior European Portfolio Strategist at Goldman Sachs. Always excellent. Thank you for your time this Wednesday morning. And coming up, chipper on chips, Volkswagen. Nice one, guys. Volkswagen says it expects the semiconductor shortage to ease during the second half of the year. We hear from its CEO. That is next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back to the Open, everyone. 44 minutes into the European trading day. You can see Stocks Europe 600 down some 0.4%. It's all about the Fed. Of course, investors brace for this biggest Fed move since 2000, and they're really trying to get more clues on how hawkish they'll be. So for the moment, markets are kind of positioned in a wait-and-see mode, but to the downside. Let's also get to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. U.S. Vice President Kamala Harris has accused Republicans of attacking women's rights following news that the Supreme Court is poised to strike down Roe versus Wade. In an address, Harris argued that a court decision on abortion would open the door to stripping away other rights, including same-sex marriage. Residents of Beijing are being urged not to leave the city unnecessarily as the Chinese capital ramps up COVID restrictions. Schools are also to be suspended for in-person classes for the next week. In Shanghai, the city's final exit from a punishing 5-week lockdown is being delayed as infections continue to appear outside the strict quarantine system. A new survey suggests pay for financial services workers in the United Kingdom has surged at double the pace of the rest of the economy since the pandemic began. According to the Institute for Fiscal Studies, average monthly wages in finance were 31% higher in February than at the end of 2019. That compared with a gain of 14% across the economy. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Laura Wright here in London. Thank you. Okay, Volkswagen has maintained its outlook for the year. Higher prices and demand for high-end cars have helped counter the supply chain crunch. The German car maker reiterated that its projections are at risk from the unpredictable fallout from the war in Ukraine. CEO Herbert Diess spoke to Bloomberg a little earlier.
The overall situation of the world now with COVID in China, the war in the Ukraine, semiconductors still on short supply. This is quite a challenging environment. So I'm very happy that we could show resilience in the first quarter. I think we're going well prepared. We have task force teams working. We hope that the situation in China will improve over time. Semiconductors should improve, so we have good predictions for that. So I think that we should be able to show some more resilience.
What makes you so confident about the development in China? China imposed some very harsh lockdowns to fight the new COVID infection waves. There's some concerns about the broader economic cooling. Are you going to be able to offset that, or are there potential risks still looming?
You're right. No, China is still very unpredictable what's going to happen there, but all our plants are working also on low volume once again. So it seems to be that we have a gradual improvement, and we hope that end of May the situation should become better there. What makes us relatively confident that even if the world economy cools down a little bit, we have very good order books. Still order intake is high. Electric cars are doing extremely well. We could double up against last year. China, we sold 30,000 electric cars. which is 4 times more than a year before. So that our product strategy is working really well. Our worldwide footprint is working, so we can shift semiconductors to where we ever have, let's say, good supply chains. The market demands are still high, so that is why I'm not too pessimistic about the year.
When we look at your European operations, you have multiple factories across the entire continent. What is the sort of like biggest potential risk from an operational point of view? Is it the potential shortage of parts? Is it energy supply? There's a big or potential risk that Russia might cut off gas supplies. Could you tell us a bit more about that, maybe?
I would say the war in Ukraine is what I'm most concerned because of its long-term effects. Now it will depend on how long is it carrying on, and it has a severe effect on raw material prices, energy costs, and it might impact Europe and especially Germany's business models quite severely if we are not able to stop that. And what's also concerning for me is that we once again, we see that the world falls apart into blocks which are trying to close down even further, which is a big concern for me, because I think prosperity and development in the world is really depending on worldwide trade and open markets. So this is, for the mid and long term, my biggest concern.
Well, that was Volkswagen Chief Executive Officer Herbert Diess, and in the last few minutes, VW's CFO has said that it's still pursuing the IPO of sports car maker Porsche. I know Matt Miller will be pleased about that. He's been eyeing a Porsche in the last 10 years. Volkswagen down 0.1%.
Okay, the EU is proposing sanctions. One of the top stories, of course, for us today on Russian oil imports. We have more on the fallout for energy markets next. Stay with us. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. We are 52 minutes into the European trading day. It is Fed day, of course. The market's expecting 50 basis points. Will there be any surprises? Will the Fed chair, Jay Powell, leave the door open to 75 basis points? You're seeing losses of 0.2%, a bit of a wait-and-see move, potentially for investors here. Every major index in Europe in the red, but only marginally. Travel and leisure, when it comes to your sectors, in the green, up more than 1%, as is energy. Brent, of course, higher. We'll get onto that story and unpack it shortly. When it comes to the sovereigns and debt, you are seeing a move higher in yields, particularly in Italy with the BTPs and the German bunds as well. The 10-year there up 5 basis points. Francine.
Now, in the last hour, European Commission President Ursula von der Leyen has proposed a new raft of sanctions as a result of the Russian invasion of Ukraine. First, she announced that Sberbank and 2 other major banks would be removed from the SWIFT payment system. Then she said that the EU would also impose an orderly, I don't know if we can do it, orderly ban on Russian oil imports, sending crude prices higher in both London and New York. Let's talk about how this may impact the global energy markets. With us now is Will Kennedy, usually the bearer of bad news, our executive editor for energy and commodities. I mean, orderly, we don't know. Good morning, first of all, Will. We don't know if it's orderly because we don't also know how Vladimir Putin reacts to this.
That's a very good point. I think the orderly bit comes from the idea that this will take time. So they've said it will take 6 months or so to stop importing Russian oil, and they give themselves to the end of the year to stop importing Russian fuel like diesel. So people have time to adjust, to prepare, to make new trading relationships, to think about how the logistics are going to work. But as you say, it's a massive change to the global energy market, to the way that oil flows around the world, and we don't know how Russia's going to react.
Does it just get redirected somewhere else? Is it just the Indians are licking their lips, they're going to be getting cheaper oil, the Chinese as well?
To some degree. I mean, we've already seen India step in to become a massive buyer of Russian oil. I think they've bought more Russian oil this year than the whole of last year. And that will happen, and we see Europe source its oil from other places. We imported a record amount of US oil last month. The Poles have a long-term contract with Saudi Arabia, so we're seeing more Middle Eastern crude come in. So we are seeing that reordering of Russian crude going east and other crudes. But the logistics will be very, very hard, and I think the expectations are that Russia will not be able to sell all of the crude that it was selling to Europe, and that it will have an impact on Russian crude production. We had the BP CEO saying yesterday that already Russian production is down by 1 million barrels a day, or almost 10%. He expects that to double to 2. The question for Russia is, how bad the impact will be on its own production.
I mean, so how much do they care about this? It feels like we're trying to, shut down the Russian economy, but they also want to shut down from the West in many ways. So even if they take a hit, could that be the game plan for Russia?
It will have to be, but it is a huge issue for Russia. I mean, supplying hydrocarbons to Europe has been a huge part of the Russian economy for decades. And while we're still buying a lot of Russian gas, and getting off Russian gas will be harder, getting off Russian oil is a huge change for the structure of the European economy and the Russian economy, and it will have a big impact undoubtedly on both sides. What may come into focus in the months ahead is, to go back to the point that Tom made, if other people are just going to buy this oil, will Europe have to look at secondary sanctions, and the US have to look at secondary sanctions and start to think about sanctions against India and other buyers? This is a pretty momentous path that we're walking down.
Yeah.
Brent currently trading up 2.6% at 107, WTI at 105, gaining 2.8%. So the market's reacting to this, and of course, Will Kennedy unpacking the complexities of this decision by the EU Commission, for instance.
Yeah, I'm shocked. I mean, if we're doing secondary sanctions, then all bets are off. So I'm pretty shocked. The market is completely ignoring this. So at some point, we hope they wake up and look at these possibilities further down the line.
Plenty more coming up. Will Kennedy, thank you. Plenty more coming up. We'll keep across the markets for you, of course, on this big day for the Fed and that decision from the European Commission. You're seeing losses of 0.2% across the European space, gains in the future stateside. This is Bloomberg.
its import hardcourts has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Ukraine is what I'm most concerned because of its long-term effect.
The brutal war in Ukraine is affecting the gas market in Europe. And what we have done over the last, I would say 9 months, is really looking for every well we can turn to increase the production.
So today we will propose to ban all Russian oil from Europe.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The 75 basis point question: when the Fed says hike, traders ask how high and how fast. A new raft of sanctions. The EU proposes to phase out Russian oil by the end of the year. It also aims to cut off Sberbank and other lenders from SWIFT. And shifting goals. Russia looks to annex occupied Ukraine, narrowing its objectives for the invasion. So we have a big market day ahead of us. Of course, it's Fed Day. We've been waiting for this very moment. 50 basis point hike, definitely now priced into a lot of these markets. But what happens next, and how hawkish will Fed Chair Jay Powell be in his press conference? You can see European stock 600 down 0.2%. Of course, bonds are falling a touch. If you look at futures in the U.S., they're pretty much a little changed at the moment. Again, investors really bracing from the messaging from the Fed, what they'll do with the balance sheet. I know that a 75 basis point hike is not something that market is pricing in, but could we be surprised? That's the unknown that I would look out for. And of course, the fact that Europe is moving towards an oil embargo, but in the next 6 months to Russia could have repercussions, not only on this crude oil, currently at 105.24, but some of the inflation expectations going forward to Europe that could also feed through the U.S. The U.S. 10-year yield currently 2.96, just shy of that 3% that we touched 2 days ago. And then you can see pretty much unchanged for these futures. So let's go straight to European map to, again, give us an indication of some of the earnings that we had out there. I spoke to the Pandora chief executive, Equinor. Two stories that didn't do as badly as some were expecting, and so they're getting a lift. Equinor, the guidance going forward is not as strong as it could have been. So it's getting a little bit of a hit, but you can see the UK down 0.2%, the FTSE MIB over in Italy, similar losses. Then you have the DAX and the CAC unchanged, really trying to wade through what we're seeing overall when the Fed decides and what it does in terms of getting away from this accommodatary policy. And of course, how do you read inflation? If you're a trader and you're not used to inflation because we haven't had any for the last 15 years, how do you position ahead of the Fed? The other story we're watching out for is Lyft. This is one of the most interesting pre-market trade, and you can see down 26% as there are questions, of course, overall about the outlook for some of these companies as we get out of the pandemic, so out of the lockdowns. People use some of these services. Lyft, their pre-market down 0.25%. of its overall value. Now, the European Union has proposed to ban Russian crude oil over the next 6 months and refined fuels by the end of the year. European Commission President Ursula von der Leyen addressed the European Parliament on the sanctions.
We will make sure that we phase out Russian oil in an orderly fashion. So in a way that allows us and our partners to secure alternative supply routes and at the same time be very careful that we minimize the impact on the global market. And this is why we will phase out Russian supply of crude oil within 6 months and refined products by the end of the year.
Let's get straight to our Europe correspondent, Maria Tadeo, with us in Germany. Maria, the million-dollar question is that it takes two to tango. The European Union can say, look, we're going to phase it out orderly, but will Putin agree with that?
Well, Putin, for starters, Francine, is going to take a big hit when it comes to the revenues that he could potentially lose from now until the end of the year. The head of the commission in that speech, she said, this war in Ukraine is going to have a cost, and it will be a cost on Russia, and it will be a heavy price. But you're very right that this could have repercussions on the global oil market, and for the Europeans, it could also come with a hefty price. But I would say one thing, Francine, we have seen already, even before this embargo was announced, that the European Union has been cutting its reliance on Russia since the war started. When you look at a country like Germany, oil imports have dropped from 35% before the war to now 12%. So perhaps on that front, the impact could be moderated. The other issue, Francine, to keep in mind here is that, as you alluded to, going into this speech, von der Leyen made it clear that this is not going to happen from one day to another. It will be gradual from 6 to 8 months. Also, countries like Hungary will get a special regime, so they approve this and get on board with it. But for the Russians, I think the point now is, how are they going to respond? Will they threaten now to cut taps? We're also moving very close to that ruble payment deadline for gas in mid-May. So this move today could really spark retaliation from the Russians, but again, also reverberations on the global commodity market.
Yeah, I guess some of the other announcement, right, not only on SWIFT, but on potash. If you put sanctions on Belarus and potash, this means that inflation on food prices will accelerate significantly.
Yes, Francine, and this would come now from Belarus, but it's interesting now that the European Commission looks at Russia and Belarus as two countries that are essentially operating under Putin's guidance and, of course, are co-belligerent in the war in Ukraine. And now this could really accelerate that price inflation that European authorities have been warning now for weeks now. They also warned that for countries that already suffer from issues related to food prices, and, of course, countries, particularly in the developing world, could see this accelerate even further and could lead to serious problems before the end of the year. The other issue, Francine, moving away from the commodity markets, is also has to do with the transportation, the brokerage, the insurance around a lot of these commodities, which the European Union says they also look to ban in tandem with the embargoes.
Maria, I just want to, quantify. I mean, these are proposals, right? I mean, I said there's basically sanction on Belarus and potash. Do we think that the European Union countries will be behind what the Commission proposed?
Well, look, Francine, if I have to be very frank with you, a day ago I would have said no. There was division. We saw it played out on Monday when energy ministers met in Brussels. But I think the key here is that the Commission and Ursula von der Leyen did not refer to this explicitly, but sources really are confirming this to us, that there will be carve-out for countries like Hungary, but also Slovakia, countries that could have potentially blocked this. And they believe that the special treatment will get this new package through the finish line by the end of the week. So really there is a sense today in Brussels that this package is almost like a done deal and will happen before the end of the week.
Great. Thank you so much, our reporter there on the ground in Messberg in Germany. Now, traders, of course, bracing for the Federal Reserve to raise rates by 50 basis points today, which would be the biggest hike since 2022 years. At the Milken Institute Global Conference, investors spoke to Bloomberg's Romain Bostic about U.S. inflation.
We don't think this is the lost decade of the 1970s. Just returns are going to be a lot lower, and we're going to have to work really hard for our clients to find those opportunities.
Multifamily in the United States is having an incredible run, and we're seeing double-digit rent growth almost across the country, and it's not letting up. And it's a big component of inflation, too, the cost of housing.
I think we're going to have wage inflation starting this summer. So I'm not going to say the word stagflation is a high risk. It's still a low risk, but it's got to be in the vocabulary for next year. And that's there's nothing you can invest in. There is no opportunity when you're in a stagflation environment.
Now we're joined by Bloomberg's markets editor Christina Keen and Freya Beamish, head of macro research at TS Lombard. Freya, what if the Fed were to actually surprise the markets with 75 basis points?
I mean, I think it would be one of those, another one of a series of hawkish shocks that's come out from the Fed since Q4. So we can't rule it out, but it could be that the Fed is about to get what it wants in essentially what is a game of chicken that it's playing with the rest of the world. The hawkish kind of rhetoric and the validation of hawkish market pricing since Q4 of last year. The nice way out of this from the Fed perspective, at least from the perspective of 2022, is if the ECB simply falls off the hawkish bandwagon and the PBOC already is capitulating with the renminbi moves that we've seen over the past few weeks. And essentially that brings down the import inflation and helps the Fed to kind of tamp down on inflation in a less aggressive way. But the other
Freya,
option being to kill equities.
So what does a policy mistake at the moment look like? Is it too aggressive or actually a Fed that's not aggressive enough?
I think there's a 2022 answer to that, and then there's a longer term answer to that. And if I can couch this in the much wider context, there is an asset cycle in the U.S., as my colleague Steve Blitz likes to say. Since the global financial crisis, there is not a credit cycle. There has been a credit cycle in China. And essentially what we see at the moment is the battle. You can couch it as a kind of a drama between tech and Chinese developers. And as the Fed tightens, it's likely, I think, probably that Chinese developers roll over first in the context of the recession that we're forecasting in China. And that actually helps the Fed out because it means that the dollar is doing some of its work for it rather than the Fed having to essentially end the asset cycle that has started since the global financial crisis. And that would be the hard landing for this year.
Yeah, the hard landing. So what's the likelihood actually that we get some kind of hard landing, and where do we end up with dollar in this scenario?
I think hard landing this year, our base case is that the growth scare becomes great enough in Eurasia, and potentially there's even a scare within the US, which we could talk about as well. And that's great enough to avoid the kind of the full hard landing this year. That's not to say that you now get a rally in equities. And I think to emphasize our longer term story for equities is that there has to be a re-rating of valuations over the next 3 years to almost as a result of the success of the U.S. economy, which sounds like a strange thing, but the success of the U.S. economy means higher interest rates, higher equity yields, and therefore lower valuations. So the hard landing has to come at some point over the next few years, but maybe it's postponed this year by the weakness in Eurasia, which brings the dollar into an even stronger position and does some of the Fed's work for it this year.
Freya, let me also bring in our Bloomberg markets editor, Christina Keen. Christina, I mean, the timing of the commission saying, look, they'll phase out Russian oil on Fed Day. Do we worry about inflation that, U.S. inflation will eventually hurt Europe much more than it does the U.S., also with that supply shock coming from China?
Absolutely, Francine. I think this really just plays into the anxieties of markets and investors when it comes to inflation, because we're not just looking at that supply shock, supply-driven, commodity-driven sort of inflation via the oil price. We're also looking at kind of more durable inflation when it comes to the price of goods and services. And so I think this all just kind of comes together, really emphasizes to both investors and policymakers themselves that this is a problem that is here to stay, it's not transitory, and they're going to have to do something about it.
Great, Christine. Thank you so much. Christina Keen and Freya Beamish, head of macro research at TS Lombard, both stay with us. Coming up, Lyft shares plunge in pre-market after weaker than expected outlook. Uber brings forward its results announcement to before the bell today. So we'll talk ride-hailing, that sector, up next. And this is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, shares of Lyft plunged after a weaker than expected outlook. Investors concerned that a planned increase in spending on driver incentives by the ride-hailing company could actually weigh on profits. Meanwhile, rival Uber's shares recovered from more than 10% fall after it said it will bring forward the results announcements to before the bell today. So joining us now to talk about tech and to talk about some of these ride-hailing apps is Bloomberg Quick Takes Alex Webb. Alex, Lyft, so it actually beat expectations, revenue, EBITDA, net basis, but why such a negative share reaction?
Well, it is to do with that spending going forward, but it's also the way that they made money. They didn't do it from adding customers. They did it from charging the customers. Well, they added some customers, but it was a lot of it to do with higher pricing. And higher pricing is something that it actually, in the long term, can turn customers off. The people sit there and they go, well, actually, why am I spending all this more money on ride-hailing when public transport is so much cheaper? So what Lyft is doing in terms of spending money is it's trying to get more supply, i.e. more drivers. If it gets more drivers, it has less surge pricing, it's cheaper for the customers, and it's also easier for the customers to get fares. So these companies would prefer to have more cheaper fares.
I mean, of course they would. We all would. But does it also, is there a problem with the sector?
It's not that straightforward, though, because actually you could say...
But is there a problem? Yeah.
You could say that actually they want to have fewer, more expensive fares if you're if Lyft itself. So that, but they prefer the that one, sorry.
But it does put off the customer. I mean, why would I pay more when I can get the traditional camera? So it seems counterintuitive. I mean, they could do it, but that doesn't really make that much sense business-wise, right?
Exactly, yeah, because like, the thing is with the sector is that they have two challenges. They're competing for customers and they're competing for supply. They're competing for drivers. So if you think about the big tech companies like Apple, well, Amazon, Facebook, Google, they're the gateway for supply, and they're also sort of the only places you can go, right? If you want to sell things online, you kind of have to go to Amazon. If you're a driver in the ride-hailing business, you can go to Lyft, you can go to Uber in the UK, you can go to Bolt, there are all these different places you can go. So they're competing on price and they're competing on cost.
Yeah, great. Thank you so much. Our Alex Webb there from Bloomberg. Quick take. Now let's get back to Freya Beamish, head of macro research at TS Lomberg. Freya, when you look at some of the tech companies, I don't know whether they're deflationary and whether this has a huge impact on us, how we measure and how we measure inflation going forward.
Yeah, it's almost like the same as commodities. The cure for high commodity prices is high commodity prices. That sort of rings true for what you guys were just talking about with respect to some of the tech companies. And I think the problem that we've seen at the moment, or that we are seeing at the moment, is that there just has been this over-extrapolation from the experience of the past 2 years into the future. And I think if you look at it, I'd almost put tech in the same bundle as goods spending, because they've been the other kind of beneficiary of the pandemic in terms of spending and in terms of inflation. And if you look at goods inflation, if you look at the level of goods prices over the pandemic, we've lost the benefit of nearly 2 decades worth of productivity growth and the integration of China into the global economy, over which time you had deflation in goods prices. And the same is kind of true with a lot of the services that were boosted by the pandemic as well. But this was a 2-year period, which was a completely abnormal period. And I'm not saying we're going back to what we had before, but there has to be some kind of a reversion to trends. And this is really the kind of the third cycle that is ending at the moment. Earlier, we talked about the ending of the asset cycle in the US since the global financial crisis, China's credit cycle, but there's also this COVID cycle that is ending at the same time, and that's where you get the scare in earnings that coming kind of most to the fore at the moment.
But Freya, are we confusing, and we had Paul Donovan of UBS earlier on, and he was saying, a lot of economists are confusing basically the wage spiral with labor productivity gains. What are you expecting wages in Europe to be?
So I think wages and inflation, there's the impression that there's a sort of a spiral going on there, but actually what you've had is you've had negative supply shocks in both of those, and you've had in the US, which has spilled over to everywhere else, a positive aggregate demand shock. And you've had this compositional shock in terms of the spending that's shifted towards the kind of pro-pandemic goods and services and away from the kind of in-person services. And that all gives the impression that you've got this sort of wage price spiral in place. You may get that further down the line. Actually, I think what you're more likely to get is a credit price spiral rather than a wage price spiral, because I think a lot of the accelerators that you had in the 70s are just simply lacking at the moment. But I think that at the moment it's a bit of a mirage that you have fast wage growth and fast inflation at the same time. It's because there's a lack of labor supply.
Yeah. Freya, brilliant as always. Thank you so much for joining us. Freya Beamish there, Head of Macro Research at TS Lombard. Now, coming up later this hour, delivery diversion. Italy's largest employer, Poste Italiane, say it will further diversify this year with plans to start selling energy services. We speak to the Chief Executive, Matteo Del Fante. He's at 9:30 a.m. London time, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. U.S. Vice President Kamala Harris has accused Republicans of attacking women's rights following news that the Supreme Court is poised to strike down Roe versus Wade. In an address, Harris said that a court decision on abortion would open the door to stripping away other rights, including same-sex marriage.
Women's rights in America are under attack. How dare they tell a woman what she can do and cannot do with her own body? How dare they? How dare they try to stop her from determining her own future? How dare they try to deny women their rights and their freedoms?
Now, residents of Beijing are being urged not to leave the city unnecessarily as the Chinese capital ramps up COVID restrictions. Schools are also to suspend 4 in-person classes for the next week. In Shanghai, the city's final exit from a punishing 5-week lockdown is being delayed as infections continue to appear outside the very strict quarantine system. A venture capitalist backed by former President Donald Trump has won a Republican primary in the U.S. state of Ohio. 37-year-old G.D. Vance, who is making his first bid for public office, beat a crowded field to become the party's Senate candidate. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Certainly, the midterm elections have become a lot more interesting. Coming up, delivery diversion. Italy's largest employer, Poste Italiane, says it will further diversify this year with plans to start selling energy services. It'll be a great conversation with the chief executive, Matteo Del Fante. We'll talk about wage increases, price pressures. We'll talk about Russia, energy, and of course, your delivery packages. Can they really compete with Amazon? This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The 75 basis point question: when the Fed says hike, traders ask how high and how fast. A new raft of sanctions. The EU proposes to phase out Russian oil by the end of the year. It also aims to cut off Sberbank and other lenders from SWIFT. And U.S. Vice President Kamala Harris accuses Republicans of attacking women's rights, with the Supreme Court poised to strike down Roe versus Wade. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Finally, Fed Day. I feel like we've been waiting for this May Fed decision for as long as I can remember. This is what's priced into the markets. Of course, it's a 50 basis point hike. Will we get it? Will we get more? Could we get less? Unlikely, but this is something that, of course, we always need to keep in mind. Bonds falling today, U.S. equity futures pretty much a little changed. Again, investors are really bracing for the biggest Federal Reserve interest rate hike since 2000. What they want to know is, what will Jay Powell do? Will he aggressively tackle inflation? What does it mean for the Fed balance sheet? And the most interesting bit, apart from the U.S. 10-year yield, which is at 2.9695, is a gauge of the dollar holding to a 2-year high. What you look at, dollar strength, of course, reflects caution over an array of risks, not only tightening financial conditions, but also China's COVID lockdowns and Russia's war in Ukraine. So the European Union plans to ban Russian crude oil over the next 6 months and refined fuels by the end of the year. Here's what Commission President Ursula von der Leyen had to say on the sanctions package.
So today we will propose to ban all Russian oil from Europe. This will be a complete import ban on all Russian oil, seaborne and pipeline, crude and refined.
Well, Bloomberg's Europe correspondent Maria Tadeo is with us in Germany. So, Maria, if you break down the announcement, how likely is it that this will get full support and it will go through, that we'll have more sanctions and we'll manage to phase out Russian oil in the next 6 months?
Yes, Francine, and today we finally heard an official by the head of the European Commission. This is a new package of sanctions that will target now oil. You heard it from Ursula von der Leyen herself. This will be a transition from now until the end of the year, but would likely see the end of Russian imports by the end of 2022. Now, two important things here, Francine. One is that there will be a special regime for countries like Hungary and Slovakia. Remember, they had said they wouldn't support this embargo because it would have a detrimental impact on their economy. They will get a special treatment up until 2023, so that could get this announcement today through the finish line. And the other thing, Francine, this is not just about oil. It really is about all the services around it. So, of course, I mean the transportation around it, the insurance of cargo ships, the brokerage that comes with it. So it would be a full phase out also of those services around the oil industry by the end of the year. Now, if you ask me, are we going to see an agreement on this? I guess the fact that Hungary does get some kind of carve out of this does mean that we're going to get it through the finish line and possibly by the end of this week.
Yeah, I mean, the $1 million question, I mean, this feels inflationary, so the $1 million question is, what does this mean for central banks? And also, how will Vladimir Putin react?
Yes, and Francine, this is not going to go without reaction from the Kremlin and Vladimir Putin, particularly ahead of that May 9th parade. This is the big victory parade that he's going to oversee in the Red Square. Now, remember, there's two key points coming up. One is that ruble for gas payment system that he says he wants. There's a big deadline coming up in mid-May. Is he going to turn off the taps? That is potentially something he could do in retaliation for the money he's going to lose on the oil. And then the other big question is this going to put an end to the war in Ukraine? Will this be enough to make him rethink his strategy? If you look at the language coming out from the Russians, it's not the case. The Russians continue to say they will achieve victory in Ukraine. And today, again, we're reporting once again that Vladimir Putin could try to annex some of these territories, but also declare full war in Ukraine come May 9th.
Yeah, I feel like there's no turning back, but hopefully I'm wrong. Thank you so much. Our Europe correspondent there, Maria Tadeo, for us in Germany. Now, Bloomberg Intelligence sees Italy as one of the hardest hit economies in the euro area from soaring commodity prices because of its high reliance on Russian natural gas. Listed on the Milan Stock Exchange, state-owned Poste Italiane is Italy's largest employer. In today's world of digitalization, the 160-year-old mail company has had to diversify into financial services, logistics, and more recently, selling energy services. Well, I'm delighted to be joined here in the studio live for an in-person conversation is Poste Italiane's Chief Executive Officer. He's Matteo Del Fante. Thank you so much for joining us. Also, it's so nice to have a proper conversation because we haven't been able to catch up for quite some time. If you look at all the pressures that you're dealing with on a daily basis, you're Italy's largest employer, there's wage inflation pressures. I mean, you don't have an easy job. Do you have to increase wages to at least align with inflation?
Wages were okay. We signed a contract in July 2021, which covered 3 years, and our employees are happy with that contract. The pressure is coming on other front, inflation side.
So where do you see the main pressure for you? You have to basically, you're diversifying, it's financial services. I mean, I was trying to explain to the newsroom, the relationship that Italians have with Poste is different because it's like one of your main, this is where you buy a lot of the services.
Yeah, we are trying to be a platform, at a national level, a platform company, which means we want to be relevant for our clients, relevant with our physical 13,000 offices. Then we have another 50,000 franchise points, and we want to be relevant in the digital space. And the two things we believe are kind of, two sides of the same coin. And that is at the moment proving the right strategy because we're seeing turnover going up. Notwithstanding, we are sitting on some secular trends on the way down. Mail is going down.
Parcels are going up. I mean,
parcels
I get so many parcels.
Parcels are going up. You've seen, results announced by, the Amazons, the DHL. The first quarter was down year on year versus 2021 because we had a peak year, but all of them are up versus 2019, so pre-COVID.
So Matteo, what's hardest for you right now? If you look, I mean, do you have a lot of competition from DHL? And I know we maybe have less parcels than the peak of the pandemic, but this is still the way of the future.
Yeah, we have a lot of competition from all the guys. I mean, there is the Amazon in sourcings. There is, Bartolini, which is a company owned by French La Poste. We have a very strong presence of DHL in Italy. We have FedEx. We have UPS. We don't miss friends in the space. But we managed to become number one B2C delivery company last year. We started in 2017, we were number 6 in logistic. So, we've done some inroads.
I mean, I'm so embarrassed. I actually know my DHL driver and other ones personally, so I don't know what it tells me about my shopping habits. But talk to me a little bit about selling energy services.
Yeah.
So again, when you're looking at the war in Ukraine, how difficult is it? So you sell a product, but you say, this may go up quite significantly for you.
Yeah, I mean, it's planned for 2022, and it was planned, a couple of years ago, and it will happen. We're doing the last mile, so we're selling the energy that we buy wholesale. So all we need is a decent level of stability in the wholesale market where you hedge what you sell to your clients. This is part of the liberalization commitments that the Italian government took versus the European Commission for the Next Generation EU. There is a lot of things that have been asked to Italy in the package, and one of the things is you have to liberalize your sale market in energy. So there are buckets of clients which are still protected under specific contracts that will have to migrate towards the market. So it's an opportunity for a company that is selling products to clients.
At a tricky time, though, because of what's happening in Ukraine.
Sure,
so what do you need from regulators? What do you need from Europe?
We were seeing some moderate stability in the gas market, in the forward market in the last couple of days. Let's see the news of this morning on oil. Clearly, this is a strong stance. The cap on price of gas is clearly, a big question. I really hope that it's not going to happen scatter, country by country, because that's not helpful.
What's your biggest concern for the Italian economy right now? Again, you're such a large employer that you really have real-world expertise about what we're living through.
I think that if the commitments that the government has taken in terms of reforms, I'm talking about public administration, I'm talking about justice, I'm talking about procurement, take place, the economy will benefit. Clearly, the war and the exposure that many Italian companies have towards Russia are, slowing down the growth. But I think it's very important that those reforms are taking place.
How much will your costs go up because of this? Rising inflation, rising raw materials, the price of energy. How difficult is it actually to forward guidance?
Yeah, we have. We were lucky. We hedged ourselves pre-war, basically up to the end of 2023, in terms of gas and electricity. So we are sheltered.
Yeah.
We face an increased cost on oil and petrol, because that's very hard to hedge. So all our 26 million vehicles that have to we have to buy petrol for them. That's going to be, but it's a marginal weight, and we're trying to make some savings elsewhere.
And are you seeing a dip in consumer demand? I mean, you have really the world data, right? Before anyone else.
We have all the information we need. We don't see an increase in savings. Let me put it this way. Usually, when people are concerned for the overall, they save more, and we see more money kept in the checking account or deposits. We don't see that yet. Consumption data, we see standard turnover in card payments. We do more than 2 billion. We're the biggest payment company in the country, so we see a lot of flows there. And we don't see a slow in consumption.
Okay, really interesting. Thank you so much, Matteo Del Fante, their Chief Executive Officer of Poste Italiane, joining us for an exclusive conversation. Now, we're just also getting an announcement from the Indian Central Bank. This is the RBI turning hawkish last month as inflation jumped. So we're looking at live pictures, traders pricing in the most aggressive hikes in the region for the central bank. And the very latest is they voted to hike a key rate by 40 basis points. Coming up, Vice President Kamala Harris accuses Republicans of attacking women's rights as the Supreme Court looks poised to strike down Roe versus Wade. We'll bring you the latest from Washington. That's coming up next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases, or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Indian Central Bank has announced that it would raise a benchmark rate by 40 basis points to 4.4%. We're seeing a bit of move on the Indian 10-year yield, rising 28 bips to 7.40%. That's the highest since 2019. So they're also dealing with inflation. This has been a bigger problem for longer in India, but of course, that was something that the market, I don't think, was really expecting it. So the RBI did turn hawkish last month, and inflation jumped. Traders had priced in the most aggressive rate hike in the region for the central bank, but today, again, 40 basis points hike is something that we need to sit up and watch. Now, President Biden has urged the election of more lawmakers who support abortion rights and will seek to enshrine protections into law. This was a 6-3 conservative majority Supreme Court poised to overturn the landmark Roe versus Wade ruling. Now, Democrats currently lack the votes to pass the legislation, even by a simple majority. Meanwhile, Vice President Kamala Harris has accused Republicans of attacking women's rights. Joining us now is Therese Raphael from Bloomberg Opinion. Therese, thank you so much for joining us. Many questions actually about, first of all, what does this do economically? How difficult is it to model, to understand whether it significantly increases inequality if this becomes law?
Yeah, I think that's a big question, and that is the one that the states are going to have to deal with now. Yeah. If this Supreme Court decision that has been leaked holds, the onus will then be on the states that are passing restrictive abortion legislation to try to mitigate the effects of that. So we know that we would expect about half of U.S. states to restrict abortion. And among those that have already passed trigger pieces of legislation, their incomes are below the national average. We also see more black women, more ethnic minorities seeking abortions. So it is going to impact healthcare inequalities, which we know are already quite significant in the U.S., and have a knock-on effect for economic inequality as well. So is it something that states would actually, consider giving support to the people affected the most, or is there a danger that, again, this gap just widens and no one's going to do anything about it? Yeah, I mean, it's amazing that the argument has been termed pro-life, because what it really is pro-birth. We still have the highest maternal mortality rates almost anywhere in the developed world. We still have no federally mandated maternity leave for women in the U.S. We have very little access to health care for women, and we see a much higher rate of problems with particularly young, unmarried women living below the poverty line, and they are, by and large, the ones who are more likely to go seek abortions. Your average woman that's seeking abortion, she's not a teenager, she's in her 20s. About nearly 60% live below the poverty line. They're likely to have more than one child, be less likely to travel long distances to access an abortion. So that is where the impact of this decision is really going to be felt. And the question is really, what are the states going to do to mitigate that impact? What do you think they can do? Or are they thinking about what they can do? I mean, there's been legislation, there's been discussion to increase the ability of adoption. Yeah. But that is just a very, very small part of what's really required here. So there needs to be full support for women in pregnancy, particularly in birth, after birth. And we also know that women who are more likely to seek abortions are less likely to drop out of school. They might have more job prospects and income earning opportunities for those choices. So the flip side of that is if you decrease access to abortion, you then have to support women who may be financially unable to support children. And I don't think we've really had a discussion that goes into that to anywhere near the level that's needed. But the Supreme are making the decision on Roe v. Wade. It's It's then going to be to the states, to politicians, to figure out how to deal with the impact of it.
Yeah, huge. I mean, it's like an earthquake, of course, hitting U.S. politics. Teres, thank you so much. Teres Raphael there from Bloomberg Opinion. Now, coming up, ESG fund flows take a smaller hit than non-ESG last quarter. We speak to Jennifer Wu. She is Global Head of Sustainable Investing at JP Morgan. That's coming up next, and this is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, global sustainable funds attracted some $97 billion in net new money last quarter. And according to Morningstar, the decline in ESG flows were roughly half as steep as that seen in non-sustainable funds. It suggests that ESG held up comparatively well as investors reacted to rising inflation and the war in Ukraine. Well, we're delighted to be joined now by Jennifer Wu, Global Head of Sustainable Investing at JP Morgan Asset Management. Jennifer, thank you for joining us. When you look at fossil fuels, because of the transition, because of the need to get away from, of course, Russian dependency, where do fossil fuels stand in this transition to a more sustainable environment?
Yeah, hi, good morning, Francine. Good to join you here. It's such a great question because I think with everything that's happening since the beginning of the year, the war, the invasion, it really has served as a catalyst to accelerate the transition to a low carbon economy, right? The recognition of how not only climate change and climate transition is something that we need to be mindful of from an investment standpoint as it presents a tremendous amount of risks and opportunities, but also at the country and regional geopolitical level, these are issues that we actually need to be really mindful of. So I think it has really served as a catalyst as we see how in Europe, for instance, the ambition is to really increase the share of renewables to 40% by 2030. And we see many countries have come out to really amp up their ambition to really increase renewable energy such that they can reduce their reliance on fossil fuels from certain locations. So I think it's been a really good and important catalyst for the overall climate transition.
Jennifer, some financial market participants, EQT comes to mind, are requiring that their investee companies sign up to the Science-Based Targets Initiative to ensure that they're headed in the right direction. What is JP Morgan planning?
Yeah, so we have been really focused on engaging with companies, not only by asking the question of, do you have an ambition to align yourselves to a low carbon economy and how that impacts your business mix, but really scrutinizing the plans and strategies that they put out. And of course, science-based target initiatives or transition pathways, these initiatives and standards out there help us to better understand and be able to compare one company to the other in a more consistent way. But I think at the end of the day, there is still a lot of nuance in the underlying plans and strategies that companies put out. So investors have to, still do the homework and scrutinize the plans so that we can ensure that it is very much linked to how companies are planning CapEx, R&D, and then also that plans that they put out is realistic.
Jennifer, critics say that ESG have become more about the financial industry moving stuff around, actually, than doing a positive impact. Do they have a point, and will it change?
Well, I think it's an interesting comment. I do believe that what we are seeing now in the market is that ESG is not really just for dedicated sustainable funds that have exclusions, right? What we're seeing is that ESG factors are now being more integrated into mainstream investing. So things such as climate transition-related risks and opportunities, that's not really just for sustainable funds, right? So every fund or every investment need to take into consideration the potential impact of physical climate risk. And similarly, like what we're seeing in the US with unionization and how that impacts human capital and productivity of the labor force, like these are issues that are not only considered by dedicated sustainable funds. So I don't think it's a matter of moving stuff around. It's really about presenting with ultimately end clients with different kind of choices, right? Is inclusions more important to you by way of doing engagement and making sure that we can promote change, or is exclusions more important to you and aligned to your values?
Jennifer, thanks so much. Jennifer Wuther, Global Head of Sustainable Investing at JP Morgan Asset Management. Now, Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta, Kaylee Lyons in New York, or Anne Edwards is here in London. It's Fed Day. Couldn't come sooner. We've been waiting for this Fed Day for what feels like a decade. No, I'm kidding. Just a couple of months. But actually, bonds are falling. U.S. equity futures fluctuating as investors bracing for the biggest Federal Reserve interest rate increase since the year 2000. We want more clues on how aggressively the Fed will tackle inflation. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
The uncertainty is bigger than ever.
You look across the globe, global forecasts for growth are being revised down.
I think we're approaching peak anxiety or peak fear, but let's be honest, I don't think anyone can consistently call the absolute bottom or the absolute top.
I think that the Fed wants to stop being a source of volatility.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, May 4th. Our top stories today. The Fed's set to unleash its biggest interest rate hike in more than 2 decades. It will also announce plans to shrink a nearly $9 trillion balance sheet. Meanwhile, India just raised its key policy rate in a surprise move. The European Union ramps up the pressure on Vladimir Putin. It plans to ban Russian crude oil over the next 6 months. And the arrest of billionaire investor Bill Hwang may be just the start. U.S. investigations into questionable trading practices are on the rise. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines and Kriti Gupta over in New York. Matt Miller is off today. And Kaylee, we have a twin focus for markets today. Yes, the Fed and the global central banking narrative, but also what the Europeans are doing when it comes to sanctioning Russia.
Yeah, as always, Anna, there is a lot of news to digest and to wait for as well. That was definitely the case in Asia overnight, although you still had some key markets closed, including Japan and China for holidays. But Hong Kong was open for trading and traded lower. Really a move led by technology. The Hang Seng Tech Index falling more than 3%. That after news of an SEC probe into Didi Global, of course, the Chinese ride-hailing giant that is listed here in the United States. Regulators here looking into that chaotic public debut of 2021, and that's creating a bit of a sentiment overhang on Chinese tech stocks more broadly. But of course, Anna, and you mentioned this, one of the big developments in the last 30 minutes was the surprise rate hike out of India. An unscheduled move higher by 40 basis points to 4.4%, and you're seeing that ripple across Indian assets, including the rupee, stronger against the dollar by about 0.4%. And in the bond market, that 10-year yield in India up a whopping 26 basis points, 7.37% or so. That is the highest going back to 2019. And of course, that surprise hike from the RBI today followed a bigger than expected hike from the RBA overnight yesterday in Australia. And of course, you're seeing that continued ripple through the Australian bond market. Kriti, up nearly 15 basis points on the 10-year today. 354 is where we sit. That is the highest going back to 2014.
Yeah, Kaylee, well, stateside, we do have a little bit of green on the screen, but remember, it is Fed Day. Happy Fed Day, I should say, to our worldwide TV and radio audience. A little bit of marginal moves here when it comes to futures trading, but remember, it is still a wait-and-see mode. We have to see what the Fed says about the balance sheet in particular. That's likely to sway the benchmark in either direction. No movement really in the 10-year yield, even though you are seeing that bond market move around the world. Once again, really anchored to what we're going to hear from the Fed. But I think all the action is really happening in the commodities market this this morning as we hear about those EU sanctions against Russia. Remember, the last time this was brought up, a banned oil imports, JP Morgan was expecting $185 oil. Of course, we are a far cry away from that, but still up about 3% when it comes to NYMEX crude, and Bitcoin up 3% as well. Let's see, though, if it stays as we talk more and more about what the Fed might do, Anna.
Yeah, absolutely. And mindful of what the Fed might do, mindful of what central banks globally are doing when it comes to tightening policy, of course, aside from some important markets like China, we see a little bit of weakness coming through on the European equity market space today. So some moves lower for stocks, down by around 0.4% on the FTSE 100 and on the CAC 40. And perhaps it is fears around inflation and higher commodity prices that is doing some of the damage. Energy stocks, one of the sectors doing quite well, as you might expect, given that we do have higher energy prices today. Chrissy was talking about WTI. Here's the Brent price. 108 is the handle on the Brent price, up by 3%. Not up to $180 a barrel, as Chrissy was saying, as we had been warned about, but perhaps that is the strength of a phased approach. That is the strength of what the Europeans call an orderly approach. It's not going to be immediate, certainly, the ban on Russian oil assets. We've got in here the Bloomberg Sterling aggregate yield, and this is the yields, or the cost, really, to UK businesses raising money, or those raising money in sterling at least, what they have to pay on that debt. And that cost for that debt is rising. The yield is rising, and it has risen to a level that is higher than we saw at the height of the COVID pandemic. And so that is giving some people reason for thought, for pause, just the day before we get to the Bank of England meeting. Of course, higher borrowing costs, very much the order of the day. Just Eat Takeaway, this is, as the name suggests, a takeaway online ordering business based in the Netherlands. The stock down by 6.8%. The COO seems to be facing some allegations of not behaving well, and as a result, the stock is moving lower. The chairman also not putting himself up for re-nomination, and that is weighing on the stock. Skanska, a construction business here in Europe, and they are talking about supply chain difficulties linked to the war in Ukraine, and that weighs on that particular business today. A focus on Russian assets is worthy today, then, as we have got quite a lot of news when it comes to the Europeans and the ban that is going to be brought in on Russian oil coming into Europe. We see moves lower on the stock story in Russia. Part of this is also to do with Sberbank is now being taken out of the SWIFT system, or de-SWIFTed. That seems to be the verb that we are able to use these days, but not able to use that SWIFT payment system in the banking space. And so that is weighing on stocks, it would seem, over in Russia. The ruble rallies, but we're told again and again by investors, by traders, that this is pretty much a broken market, Kaylee.
Anna, just some breaking news we wanted to mention out of China. Local government officials in Beijing are giving a briefing on COVID-19 and say that Beijing will extend restrictions that have been put into place during the holiday. Of course, the May Day holiday, which the last day of it was today. Those restrictions include halting dining in at restaurants, as well as a closure of gyms, requiring some testing for places like parks and monuments. You would have to have a negative COVID test to get in. We've seen the shuttering of schools as well. So continuing to monitor those developments in China as they deal with an outbreak of COVID-19. Now, in addition to monitoring that, let's talk about what else is ahead today. We will be getting some U.S. economic data, including MBA mortgage applications, as well as trade balance. Then Uber will be reporting its results at 7 a.m. New York time. That report was actually moved up. And then, of course, the big event of the day, Creedy, the Fed decision, 2 p.m. New York time.
Yeah, well, let's stick with that, Kaylee. Chair Jerome Powell poised to unleash the central bank's most aggressive action to battle inflation in decades. Michael McKee, Bloomberg International Economics and Policy correspondent, joins us from our D.C. bureau. Mike, thank you as always for getting up early for this, what is poised to be a historic day in the from the Federal Reserve.
Yes, Grady, it was 2000 when the last time the Fed raised 50 basis points was, and it was just before a recession. So that's the question in the markets. It's not what the Fed's going to do, but how the economy reacts, and does the Fed have to get even more aggressive given what's been happening this morning? You can see in the WIRP function on the Bloomberg that traders have almost priced in a 75 basis point move for June. We're expecting 50 today. So a lot of people are going to be looking to Jay Powell when he holds his news conference at 2:30 New York time today to give us some sort of indication of whether it would do that again, whether it's that important. This is, as I say, the first 50 basis point hike since 2000. But it's not really where they are, it's where they're going that everybody's wondering about. Where do they end up? 2.5%, 3%, 3.5%? They've said they want to get to neutral by the end of the year, and that's going to be the real question. How quickly do they move? And now we've had this news this morning about an oil embargo of Russia, and as Kayleigh was just saying, extended lockdowns in China, those are only going to add to inflationary pressures. So a lot building up for Jay Powell and the Fed.
Yeah, absolutely. And Mike, the global agenda is interesting when it comes to central banks around the world hiking, and India's central bank delivering a surprise hike today, coming on the heels of surprises in some shape from the Australian central bank. Hawkish surprises seem to be something we're getting used to.
Yes, it is, I suppose, possible the Fed could go more than 50 today, given what's happened in Australia and in India. The Indian central bank governor pointing out inflation is just getting worse, particularly food in their country because of the war. And tomorrow we have the Bank of England expected to raise rates and start talking about the possibility of QT, quantitative tightening, selling off some of their sterling holdings. So it is a different environment than people are used to, and very quickly we're not going to be where we were for the last 2 years. We'll even get back perhaps to the place we were right after the financial crisis of 2008, when you get into 2017-18 when they started raising rates.
Mike, thanks very much. Bloomberg's Mike McKee with us to talk us through the Fed story. And stay with Bloomberg for special coverage of the Fed decision and the news conference. That is at 1 p.m. in New York, 6 p.m. in London. On to our other top story today, and the EU plans to ban Russian crude oil over the next 6 months. That's part of another round of sanctions to increase pressure on Vladimir Putin over his invasion of Ukraine. European Commission President Ursula von der Leyen spoke to the European Parliament this morning.
We will make sure that we phase out Russian oil in an orderly fashion. So in a way that allows us and our partners to secure alternative supply routes, and at the same time be very careful that we minimize the impact on the global market. And this is why we will phase out Russian supply of crude oil within 6 months and refined products by the end of the year.
Let's get more with Maria Tadeo, our European correspondent, who's reporting from Germany for us today. Maria, tell us more about the sanctions then. We heard Ursula von der Leyen speaking about oil taking the headlines, but there's more detail.
Yes, Anna, and this is a new package put forward by the European Commission. The head of the Commission, von der Leyen, today said this war in Ukraine needs to have a price, and Vladimir Putin is going to pay for it. Now, when you look at the measures announced today, clearly the takeaway is that oil embargo, but there's some details here that are worth keeping in mind. Yes, it's a full oil embargo, but only by the end of the year. There is a 6 to 8 month transition period so that countries like Germany, by the way, where I'm in today, will have time to adjust for it. And then, of course, there's a number of strings attached that come with it. There will be a special regime for countries like Hungary, Slovakia. Remember, at one point, they said they would not be on board with this embargo because it would be detrimental to their economies. A lot of this is designed to get this new package through the finish line. It will also target Sberbank, the Russian bank. And it's not just oil, Anna, but it really is the services around it. The European Union says it will put an end to things like the transportation, the brokerage, the insurance that comes with those oil ships into the European Union. The big question now is, how is Vladimir Putin going to respond to this? Remember, the Kremlin has said it will go tit for tat on countries that are, quote, unfriendly with Russia. And then, of course, this is going to put an end to the war. Will this make Vladimir Putin rethink his strategy in Ukraine? Well, if you look at the language coming out of the Kremlin, it's the opposite. The Russians say they will achieve victory in Ukraine. And of course, we hear that a lot of the focus now will be on the east and incorporate in some of the occupied territories by May 9th. That is a big victory parade. The Soviet Union victory over Nazi Germany for Vladimir Putin is a key date.
Well, and Maria, of course, what's happening in Ukraine is a big focus in Germany today. You're in Meseberg as the German government wraps up a 2-day special cabinet meeting. Really, what's the focus of that?
Well, a lot in focus, Kayleigh, because this is a country and a government. Chancellor Scholz, by the way, will be here alongside his top ministers. This is a country, as I said, that is having to almost undo in real time, in record time to some extent, about 15 to 10 years of appeasement when it comes to Russia, this trade-led foreign policy. Germany, many would argue the issue here and the big criticism is that it failed to separate security from politics to energy. All of this is coming now undone. So clearly the focus will be now on how to recalibrate this. And by the way, Kayleigh, it's not just Russia, because that is a supply shock, but there's also a demand issue here coming potentially from lockdowns in China. So this is a turbulent time for the German economy, no question.
Bloomberg's Maria Tadeo reporting from Brandenburg, Germany. We thank you as always. And from Germany, let's return stateside. President Biden urging the election of more lawmakers who support abortion rights following news that the Supreme Court is poised to strike down Roe versus Wade. U.S. Vice President Kamala Harris also weighed in on the matter yesterday.
Women's rights in America are under attack. How dare they tell a woman what she can do and cannot do with her own body? How dare they try to stop her from determining her own future? How dare they try to deny women their rights and their freedoms?
Anne-Marie Herdern, our Bloomberg Washington correspondent, joins us now. Anne-Marie, day 2 of this saga, and emotions clearly running high.
Yeah, this was probably the most impassioned and robust speech we've heard yet from the Biden administration, and on the heels of also the president talking about this, and the president really pointing the finger to the fact that if this is overturned and the Supreme Court does strike down this 1973 law, which gave women the constitutional right to seek an abortion, reproductive rights for women will be top of the agenda for the upcoming elections. And really where the world is going to, and analysts are going to be honing in on, is suburban women, because rural parts of America really are Republican. Then you have very much strongholds in cities for Democrats. It's suburbs where really elections can be won. We saw that in 2018 when the Democrats gained a number of seats in the House, 41 seats they picked up. We also saw that in the last presidential election where President Biden, this was a pivotal moment, he was able to pick up that suburban vote, and women are going to be top priority for them. And this may be an issue that it can eclipse everything else, including inflation and COVID-19.
Well, while we're talking about elections, Anne-Marie, we also have to talk about what we saw happen in Ohio yesterday, the Republican primary for Senate. J.D. Vance, the venture capitalist endorsed by President Trump, winning victory there. How much should we read into that as an indication of how midterms are going to go?
Yeah, it was a very crowded race. He beat out 6 other individuals for this, and he picked up that Trump endorsement that does seem to help him and push him over the line in a moment where he was not as high in the polls as some of his other challengers. Analysts say we shouldn't read too much into this just yet. This is just one race, but certainly with J.D. Vance, as you say, this venture capitalist backed by Peter Thiel as well. Also, many have read his book, Hillbilly Elegy. It's not just him that has won this race now. This was a big moment for the former president, who's, of course, trying to make sure his stature in the Republican Party. And as he talks about these other candidates he's going to endorse, he also flirts with the idea that he himself will run again for president in 2024.
All right, Bloomberg's Anne-Marie Hordern in Washington for us. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. I have to begin with the big plunge to the downside that we are seeing for Lyft. It, of course, reported after the bell yesterday. The issue is not demand. They are seeing a robust demand recovery as people emerge from their pandemic-era habits. The issue is they can't attract enough drivers, a problem that has only gotten worse as gas prices have gone up, which really crimps the take-home pay for those drivers. So Lyft is going to spend more on incentives to get drivers in the cars. The problem is that's going to weigh on profitability. Dan Ives over at Wedbush saying that spending like an 80s rock star is not going to fly with investors, and it certainly is not flying with them this morning. That stock down 26% before the bell, taking Uber down with it, which of course we'll report later on this morning. Uber is down 4%. A different story, though, when it comes to Starbucks. Yes, they are facing a big issue in China with the lockdowns. That's why they suspended their 3rd and 4th quarter guidance because of a lack of visibility. But ex-China, everything else is looking pretty good. So that stock is up about 6.3% before the bell. And another upside move for AMD, the chip maker, giving a strong forecast, indicates good demand for its data center chips. As a result, that stock up about 5.5% before the bell, Anna.
Kaylee, coming up on the program, Chris Watling, Longview Economics CEO and Chief Market Strategist, will join us. What is he expecting and looking for from the Fed? And Wall Street crackdown. The Bill Hwang case is just the first in an upswing of federal investigations into a slew of suspected trading abuses. More from our big take story. That's still ahead. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Today, a Bloomberg exclusive. J.P. Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the J.P. Morgan CEO Summit in London, only on Bloomberg TV and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. We are staring at a potentially historic rate hike in the books today, a 50 basis point hike. At least that's what's priced in the market. But I want to go back to the last time we were looking at financial conditions and when they were this tight as they were, taking into account the stock move, taking account to the dollar strength and other financial conditions, well, credit spreads, for example. The last time we saw it was back in 2018. And when we were here, the Federal Reserve was actually looking to pause that aggressive tightening policy. Here we are again, and now we're looking at a historic rate hike. What are the parallels we should really be following? Let's get some expertise here. Justina Lee, Bloomberg Markets reporter, joins us now. Justina, thank you as always for making the time. This is really interesting. What is it going to take for the Federal Reserve to ease, just as we're talking about this historic aggressive rate hike regime?
Right. I think your chart really shows the position the Fed is in right now. Because, today we're expecting them to focus on capping inflation expectations with a 50 basis point hike. But at the same time, we're also seeing signs that maybe demand is cooling, because of the China slowdown or the impact from the war. And as your chart shows, financial conditions have already tightened quite a lot. And so, can the Fed still shock markets by kind of making expectations even more hawkish from here? I think that's kind of the question markets are focused on today.
And broadly, Justina, we've seen, of course, a bond rout taking place as a result of concerns about higher interest rates. Today, we see that the short ends of the Treasury curve, yields are rising there, going down at the long end. And that seems to be the type of market reaction where markets get nervous about slowing growth, about whether the Fed tightens too much. Do we read anything into today's slight flattening?
Yeah, because it's not always that in every hike cycle that yields just keep going up. And so I think the question here really is, when do investors start shifting their concerns, from inflation to the prospects of slower growth? But I think for now, the market is still focused on what's going to come out of the Fed meeting today, not in terms of necessarily the decision today, but in terms of the next rate hike coming in June.
Yeah, and with so many uncertainties around commodity prices, which are on the rise this morning, of course. Justina, thank you very much. Bloomberg's Justina Lee. For more market analysis, you can check out the Markets Live blog, MLIV Go. That's the function to use on your terminal. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Up to date with news from around the world, here's the first word. India is pushing Russia for bigger discounts on oil as other buyers turn away. Bloomberg's learned that India wants to pay less than $70 a barrel to compensate for additional hurdles such as securing financing for purchases. Brent is trading around 108. Elon Musk reportedly wants to eventually take Twitter public again. He has agreed to take the company private in a $44 billion deal, but according to the Wall Street Journal, he has told potential investors he could return Twitter to public ownership within a few years. Coming up, we'll talk about the Federal Reserve decision later today. Chris Watling, Longview Economics CEO and Chief Market Strategist, will join us. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 juta itu nyampe. dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Federal Reserve Chair Jerome Powell is poised to unleash the central bank's most aggressive action to battle inflation in decades. Policymakers are expected to raise interest rates by 0.5 percentage point when their two-day meeting ends today. Meanwhile, India's central bank raised its key policy rate in a surprise move earlier this morning. The European Union is ramping up the pressure on Vladimir Putin. It plans to ban Russian crude oil over the next 6 months. The EU also will ban refined Russian fuels by the end of the year. And the arrest of the billionaire investor Bill Hwang may be just the start. U.S. investigations into questionable trading practices are on the rise. Those probes all center on the same question. Are the markets rigged? We will discuss in just a few moments' time. I'm Anna Edwards in London with Kaylee Lyons and Kriti Gupta in New York. Matt Miller is off today. And Kriti, as we started the program, same two thoughts occur. You know, we're watching the Fed. We're also watching the developing sanctions story now into its 6th round from the European Union against Russia.
And that's really where all the market action is, Anna. You are seeing a little bit of marginal gains in futures, not really a ton of movement in the 10-year yield as well, but you are seeing a lot of movement here in the crude, in NYMEX crude, up 3%. And once again, it comes on the idea that if you start to ban oil imports, that's naturally going to be a bullish driver for oil prices. JP Morgan, for example, forecasting that in that scenario, oil would hit $185. We are only at 105 because think about it, we're balancing some of that sanction talk with growth concerns over in China. Earlier in the show, we talked about Beijing extending those restrictions as the 2nd largest oil consumer in the world. You are seeing some kind of tug of war dynamics here in the crude market. Bitcoin up as 3% as well. The question for Bitcoin here, and Matt Miller would be proud that I brought this up, is it that inflation hedge that a lot of people were calling it as we talk about a historic rate hike? I'm very curious, Kaylee, to see how Bitcoin in particular reacts to what we hear at 2 p.m. today.
Yeah, and Bitcoin's still in and around that $38,000 level, Kriti, so still in the range, actually at the lower end of the range it has been in for all of 2022, even as inflation heats up. So is it really a hedge? A question we will continue to ask. Now, as for the markets and the moves in pre-market trading here in the U.S., the big underperformer would be Lyft. That stock is down about 26% at this point. The issue here really is that they need to get drivers. They need to pay them, incentivize them more to join up and drive for Lyft. The problem is that's going to weigh on profitability. So a big decline for that stock this morning, and it's dragging on Uber as well. Uber, interestingly, was supposed to report after the bell today. It's now reporting pre-market. So I wonder how much we should read into that, but that stock is down 4% at this point. You also have Akamai down as well after giving a disappointing forecast. The company struggling with slower internet traffic as well as some issues with the war in Ukraine. That stock is down 14%. But Airbnb, a more positive story. Great forecast given. It's really optimistic on summer travel, Anna, kind of joining in a lot of travel peers like Expedia in forecasting a really strong summer travel period as people get back out there after the pandemic. That stock is up about 5% before the bell.
Yeah, plenty of stories about busy airports globally, of course. Let's get back to the European session then, and European equity markets 2.5 hours into their trading day. And we're moving a little lower here for European stocks, perhaps shaken a little by what we've heard from the European Commission in terms of the ban on oil from Russia. That is certainly moving the Brent crude price. Kriti was talking you through the WTI price. Well, Brent crude also up by 3%. Where does that leave us in terms of inflation and the cost of doing business? And maybe that has a European dimension to it. And Stocks Europe 600 down by 6%. 0.6%. We've also seen some gloomy forecasts from some of the companies that operate within the retail space and are exposed to the European consumer, and that is having an impact. I've also got here the Bloomberg Sterling aggregate. This is a yield, and this is for high-grade debt, sterling denominated for European corporates. And those that are borrowing in sterling, this is the price they're going to have to pay. And this price, this yield, has now got up to similar levels that we saw during the height of the pandemic. So the concern here is that the cost of borrowing for companies, just a day before we hear from the Bank of England, where the expectation is we see a higher interest rate, that cost is going higher, and the market, certainly that market theme, very much intact for us. Just Eat Takeaway, a takeaway food ordering business based in the Netherlands. The COO of this company having to step aside, accused of misconduct. The chairman also deciding to step away from the business, and that stock down by 7.8% as a result. Russian assets firmly in focus as the EU bans the import of oil from Russia, albeit with a lag. 6 months in the case of crude is that lag. They've also said that they're taking Sberbank out of the SWIFT system, so the SWIFT financial payments system, de-swifting, if you like, Sberbank, and so that is having a negative impact on some in the financial sector over in Russia. So we see stocks moving lower. Here we've got the Russian ruble gaining a little bit, but we're told often that this is a broken market. It seems that Russia has avoided default, at least in the very short term, when it came to those dollar-denominated payments it was due to make just yesterday, just today, in fact, Kaylee. All signs seem to point towards they have avoided that default, but we'll see what happens in further payments.
Yeah, of course, emerging market investors watching that one very closely, Anna. They also are likely watching Indian assets today. I just took a peek at the 10-year Indian yield, up 24 basis points on the day after a surprise rate hike from the RBI. And of course, that move followed a surprisingly large rate hike out of the RBA yesterday. Today, it's going to be all about the Fed. Most economists expect that the central bank will deliver a half-point hike, along with hints about further increases. Joining us now to discuss is Chris Watling, CEO and Chief Market Strategist at Longview Economics. Chris, given what we've seen in Australia, in India, how much room is there for a hawkish surprise out of the Federal Reserve today?
Well, it's possible, of course, but I mean, the Fed's language has been extremely hawkish, really, for the last few months. Really since the minutes in early January, they've been dialing up their rhetoric, culminating with discussions of potentially a 75 basis point hike from one or two governors over the last few weeks, and a sense that QT is about to happen and about to be announced later on today. So I think, if anything, there's a bit of a risk of a surprise the other way. The market's been teed up to be very hawkish, to expect hawkish commentary. It's had a lot of Jerome Powell banging the drum along with all the other governors. And I think there's every chance that they may feel they've priced a lot in, and they may even just dial back a tiny bit. Not much necessarily, but a tiny bit.
So, Chris, is what you're suggesting, though, that if they were to move 75 basis points, the market would be fine with that?
It depends how they do it. If they move 75 and make it a statement and it allows them just to ease off a bit in terms of rhetoric or something, or they do 75 and they make acknowledgement that there's some softening of growth and therefore inflation is likely to follow. It depends exactly how they do 75. If they just do 75 and say, actually, we're more hawkish, we're going to do another 75 probably in a few months' time, then that would be taken poorly, I think, in terms of, it's a doubling down on that hawkish rhetoric. But as I say, if they do it with a sort of a slightly dovish tilt, and I wouldn't want to over accentuate the word dovish, but if they do it with some conditionality, as I say, something softening on growth or something like that, then actually the market may take it okay.
Okay, that's an interesting perspective then. Interesting to, absolutely flag that it depends how hawkish or dovish they are in the commentary that goes along with whatever hike they do deliver then, Chris. Let me ask you about a growth focus. What do you think we will hear from the Fed around the strength of the US economy? Because that's crucial in terms of the market's assessment of how many hikes the Fed thinks it will get done during this cycle.
Yeah, I mean, I think there's an argument that they might talk about the temperature being a bit cooler, certainly in terms of growth. So, we had ISM new orders again the other day. Over the last couple of months, they've softened pretty sharply. Housing's coming off its hottest temperature, if you like, and there's a bit of softness there in mortgage apps and things like that. So quite a few parts of the cyclical part of the economy are feeling the effects a little bit of higher rates already. So there's definitely an argument that they may dial down the discussion of the strength of the economy. Payrolls remain pretty good, but those other parts, as I say, payroll's a bit of a lagging indicator. Those other parts have seen some softness. So I think that's really a key area to watch tonight, what they say about the economy, the update on that, and any comments along those sort of lines.
What about the international influence here, Chris? I mean, clearly they set policy for the US market, but it is influenced by international factors. And I'm thinking about Chinese growth. I know that Bloomberg Economics have been asking whether weakness in Chinese growth might actually slow the pace of hikes from the Federal Reserve. They say it's too soon for that to actually happen, but it's something they're thinking about. Is that a connection that you think the Fed will increasingly have to look at as we go through this year?
Maybe as we go through this year. I don't think, personally, I think what we're seeing in China is an easing cycle, so we're going to get an acceleration of Chinese growth, and in that sense it's in a completely different place to what you see in the US and other central banks in the West. But I'd be very surprised if they made even a hat tip towards the Chinese housing market tonight. I think it's all eyes on US growth and all eyes on the outlook for US inflation, and all eyes on how hawkish the Fed feels it needs to be and whether or not it feels it's done enough heavy lifting and jawboning of the market, which is really what it's been up to over the last few months. So yeah, I mean, China may feature later in the year, but I you know, unless it falls apart sharply from here, which, as I say, I don't think we expect, then I don't think China will be a main focus of tonight.
Chris, we're talking about a historic rate hike here, the first 50 basis point hike priced into the market since May of 2000, 22 years. But I have to ask, what is it going to take for the Federal Reserve to start easing again?
Great question. I mean, I wouldn't be surprised if we got a cut next year. You know, that's not impossible. Now, that would come after a whole series of hikes this year and some quantitative tightening. I mean, the interesting thing is what we're doing is we're unwinding, firstly, funny money. We're moving back to what I would call normal monetary policy from easy. And then the question is whether you start to move towards tight. And certainly the pace we've seen from the Fed, the language we've seen from them, I think means that once we get towards the end of this year, there's going to be some pressure the other way for 2023. There could be some real challenges on growth. There could be some challenges in the way financial markets behave. There is a bubble in the US financial market. It's perfectly plausible that it's popped by expensive money later this year. Some would argue it's already popped. I'm not convinced that's the case, but there's definitely an argument that later this year that comes to pass. And therefore, you know, 2023 could actually see a cut. So, you know, we need money to get tight first, but then you could easily get to that stage where, as I say, next year the Fed's actually looking the other way and moving the other way to try and offset some of the downdraft from financial markets deteriorating and from some softness in the economy.
So a potential cut in 2023, but then you add on European sanctions and oil import ban of Russian oil. Calls that on Wall Street have really been made for as much as high as $200 oil on the back of that sanctions package. Does that prolong the 2023 cut in your view?
No, because I think the growth of money supply is already slowing dramatically. It's, you know, if you look at M2 money supply growth, it was 25% or so last year. It's now down under 9%, 8-9%. It's slowed very sharply and it's slowing sharply. That's the trajectory. And if that continues, what will happen is an oil price spike will be deflationary, not inflationary. Remember those days? Back in the old days, we used to say whenever oil price went up, it slowed the economy, it was deflationary. Now, because there's been so much money around in the last 2 years, it's been inflationary. But I think if you roll forwards, you'll find into 2023, it's back to the old deflationary style. Because money supply growth is slowing, and if the Fed keeps doing what it's doing, it's going to continue to slow. So there's less money to go around, and that's the way oil price plays out. By the way, I'm not convinced oil goes to 200 anyway. I wouldn't be surprised. I realize there's a sanction risk, but I wouldn't be surprised if we'd already had the high in the oil price on March the 7th.
Interesting that we only, in inverted commas, got as far as 108 on Brent today on the back of the EU's oil announcement. Chris, thank you very much for joining us. Chris Watling, CEO and Chief Market Strategist at Longview Economics. Coming up, Wall Street crackdown. The Bill Hwang case is just the first in an upswing of federal investigations into a slew of suspected trading abuses. More from our Big Take story next. This is Bloomberg.
during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Preeti Gupta with Kaylee Lines in New York and Anna Edwards in London. Matt Miller is off today. That case of Bill Hwang is the first in an upswing of federal investigations into a slew of suspected trading abuses. 3 other sprawling inquiries have emerged in recent months, examining so-called block trades, short sales, and well-timed wagers. They all center on the same question: are the markets rigged? That's the topic of today's Big Take. Bloomberg's Sri Natarajan co-wrote the story and joins us now. Thank you for waking up early for us, Sri. Let's start off with this Bill Hwang arrest. Is it surprising? Do we see more coming?
Well, we obviously knew that there was a big investigation going on into Bill Hwang and Archegos over the last year because of the tremendous collapse of his family office. But we also know that over the last few months, his attorneys, even Bill Hwang himself, had been cooperating with the SDNY, had been going in for interviews, and yet all of a sudden, on the very day that his attorneys thought that they were having productive conversations with prosecutors, a sealed indictment was filed. 2 days later, he was arrested at the crack of dawn. That caught a lot of people by surprise, and the charges are also interesting. Racketeering charges, 11 felony charges, and possibly the rest of his life in prison. Yeah. That's caught everyone to pay attention.
Well, and of course, regulators and prosecutors are not just looking at him as an individual. There's also probes going on into block trades, things like short selling. I mean, this is a more holistic, all-encompassing view into things that haven't necessarily faced this level of scrutiny in the past.
It certainly feels like what people are calling the everything crackdown. Across the board, you're seeing the DOJ, the SEC, other regulators ramping up their scrutiny into corners of Wall Street that they didn't pay too much attention to in the past. Granted, these things are cyclical, they wax and wane, but during the Trump presidency, you did certainly feel that, relatively speaking, there was a more lax approach, and there's been a complete turnaround. They are making cases easier to start, faster to finish, and they want them to be more punishing to send a message to Wall Street.
Yeah, Sri, good morning. Is there a sense then that this comes right from the top? I mean, you mentioned the previous administration. Do we get a sense that tackling white-collar crime is a real priority then for this administration?
No, absolutely. On the day that the Archegos charges were unsealed, you had the Deputy Attorney General of the United States, Lisa Monaco, at the press podium in Manhattan commending investigators for how quickly they moved on it, and also making the point that these are exactly the type of cases that the DOJ should be going after. So it certainly feels that across the Biden administration, across the regulatory and enforcement land, there is a greater focus on everything Wall Street, on everything that people are complaining about. They want to be clear that they are presented as the folks who are going up against Wall Street.
Well, and of course, to that point, Gary Gensler certainly trying to crack the whip as well. Again, though, these are kind of, as we were talking about, gray areas, or at least they have been in the past. Is there a risk that regulators are going to make the rules as they go here, and you'll be punished in hindsight for things that didn't necessarily have punishments that go with it?
I mean, there's certainly an interesting concept known as rulemaking by enforcement, where you have what you think are regulatory gray areas, where traders thought that it is in the gray that they could operate. Prosecutors really want to bring cases where they make it clear that they need to be far away from that line. So that risk certainly exists, and that is something a lot of defense attorneys, all of Wall Street, the big banks, the buy-side firms, the hedge fund, private equity firms, everyone's going to be paying close attention to.
Sri, thanks very much. Bloomberg's Sri Natarajan with the latest on that Big Take story. Bill Hwang's arrest sets the stage for Wall Street crackdown. More on the terminal. Now, coming up in the next hour of programming, an exclusive interview with JP Morgan CEO Jamie Dimon. That is at 6:30 a.m. in New York, 11:30 a.m. here in London. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The risks of having a perfect storm where Europe is in recession because of the war, China's in recession because of a failed COVID lockdown policy, and the United States because the Fed tightens too much, too fast, and, or, you know, however we judge it in response to inflation. And those all feed on each other.
Harvard economics professor Ken Rogoff speaking yesterday on Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and none other than Tom Keene, who will be also leading our Federal Reserve coverage today and is joining us now. Tom, what is your single best Fed Day chart?
The single best charts to get us ready for a 1 hour earlier Fed Day. We're going to start at 1 p.m. this afternoon. Kaylee, the meeting is so important and really so historically inconsequential, as you heard from Professor Rogoff. Let's look at the great disinflation. This is a very familiar chart to Global Wall Street, but always bears repeating, particularly on an historic day like this. Up from the 71, 50 years of the Fed rate up to the Volcker inflation. Down we go, the great moderation. We flatline. There's a little bit of recovery, and then it drifts away.
And you're going to be speaking to a perfect guest on this subject, the Nobel Prize winner in economics, Paul Romer, who I know operates at the juncture of economics and technology.
Yes.
Someone who can comment on that deflation, Tom, and also Jamie Dimon on the program, of course.
Well, Mr. Dimon will be with us, I believe, with Francine Lacroix. We're really looking forward to his comments here, particularly after his 40-some page annual letter. This is the morning show with the laureate, Paul Romer, and you're absolutely right, Anna. Paul Romer is about the technology we observe and maybe that we don't understand. And just as well, we go on to the Fed meeting and we start strong with Matthew Lazzetti of Deutsche Bank. And I can't say enough about their recession call.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you. Looking forward to the coverage over the next 3 hours and, of course, this afternoon for The Fed Decides. Now, of course, when we look at what we're watching today, I will be watching Tom, John, and Lisa talking about the Fed decision, but also, guys, the market reaction to it, because this is a market that has come so far in pricing an aggressive and hawkish Federal Reserve. The two-year yield is already up more than 200 basis points year to date, and it is only May 4th. So my question really is, what could constitute a hawkish surprise from the Federal Reserve today, considering we have an RBI that just came out and hiked rates, surprisingly, an RBA that hiked more than expected just in the last 48 hours. So could the Fed come out and do the same? But of course, we were talking to Chris Watling of Longview Economics earlier today, who said even a 75 basis point hike might be something that the market is able to digest depending on how the Fed does it. So really interesting to see how the market takes down not just the decision, but whatever Jerome Powell says at that press conference. liquidity.
Yeah, and interesting comments will be also what he says about the growth picture. We know decelerating growth is the dynamic here, but we also see it on the micro front, right? We see earnings as well. Lyft, for example, plunging this morning on that disappointing growth outlook, and something investors really aren't hesitating to punish those growthier stocks for. So what I'll be watching is those earnings for Uber, expected at 7 a.m. We know has been pushed up. It was supposed to be after the bell today. Instead, it is pre-market. I wonder what they have to say on the growth picture, Anna.
Yeah, absolutely. I wonder what they have to say on the growth picture. Also weighing into the growth picture is what we've heard on oil today from the Europeans. The European Union then sanctioning the Russian oil. How high does the oil price go on the back of that? That's crucial. We talked to Chris Watling about this as well from Longview Economics, and he was saying that perhaps we've even seen peak oil. We will look back on this day and ask ourselves whether that was true or not. But 108, up by 3.5%. At a time when we saw the Europeans ban Russian oil, or at least they say they're going to in the future, with a 6-month lag, and maybe, Kaylee, that makes the difference. Because this inflation dynamic around commodities ties in very much to the Fed.
Absolutely, Anna, and we have to keep in mind, this is oil we're talking about for Europe, which is far less important than gas. Gas would be an entirely different conversation, I think.
Yeah, absolutely. A different subject altogether, one we may or may not be having in the future. That is it for the early edition. Surveillance is up next. Tom, John and Lisa will be taking you through the next few hours and taking you through the Fed Decides. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What the Fed really needs to deliver is a bit of shock and awe.
What the market's going to care about the most is what are the odds of 75? And again, we think that Powell is not necessarily going to fan those flames.
Central banks, of course, were not expecting this inflation. They hadn't seen inflation for a long time.
I don't see how inflation comes down with the Fed funds rate on a still accommodative setting.
They're going to hope that they can tame inflation without killing off the business expansion.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Fed Decision Day, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures positive 0.4% on the S&P. TK, that Fed decision just around the corner.
Just around the corner. We're going to start an hour earlier today. 1 o'clock, folks, with the recession guy, Matt Lazzetti, and that's in the back of everyone's mind here, John. I think we're all moving forward to the next set of meetings, and part of that is a presumed economic slowdown.
Show me June and show me whether you would like a 75 basis point rate hike. There are some, Tom, I know it will frustrate you, that want the answer to that question.
Yeah, I'm just not going to go there today. I think we're widely presumed 50 basis points. What I'm looking at, John, is the data, what is going to matter within the press conference, and it's got to come up just front and center for me today. I'm going all Javier Blas on you. Is diesel from the last meeting to this meeting is surging. Javier Blas tells me 6 days in a row, a 508 on March 16, out to 543 this morning. That number is just published moments ago. John, diesel is 16% of America's energy consumption. It matters.
A lot has changed, Tom. A lot has changed in the price of fuel. Yes. A lot has changed in the price of this market too, Lisa. Whether you look at the bond market, 2s or 10s, the equity market, the S&P or the NASDAQ, or for the dollar, that matter as well.
There's been a lot of adjustments ahead of this Fed meeting, which raises a question for me. You say, what do we find out about June and whether they're going to raise rates by 75 basis points there? My question is, why are they going to wait till June? Why don't they do something bold in this meeting? Are they going to signal that? Are they going to signal some sort of reduction in the balance sheet sooner than June? I mean, everyone's talking about some sort of telegraphing and data dependency, whereas, John, you have pointed out again and again, what data are they looking at? Because the data is coming in, and it's coming in hot.
I'm not suggesting they will hike in June by 75 basis points. Nomura is. Nomura thinks they will do that. How he answers that question in that news conference today, I think, is going to give people some signal about what they're going to do in June, not just in June, but beyond June through the rest of this year.
It'll indicate how far they think they may have to go, how much urgency they feel. But again, this goes to the balance sheet also. Yes, there's a question about 75 basis points in June. I want to know why why they're waiting so long to start to unwind some of the balance sheet, given the fact that we're still hovering around that $9 trillion figure, and we do have financial conditions that perhaps aren't tightening as much as some people would like to see.
I want the answer to this. Why has the president scheduled an address at 2 p.m. Eastern time? Why has he done that?
You know, that's a great question. He's going to talk about economic growth. He's going to talk about jobs and deficit reduction. Is this his way of trying to message ahead of the Fed's press conference to basically take the decision and transform it ahead of Powell? Honestly, I can't really.
What do you make of that, Tom? To have a sort of news conference with the president, I don't think it is a conference because I doubt there'll be any questions, but an address by the president of the United States, 30 minutes before the chairman speaks, and just a couple of minutes after, we get a decision.
Exactly. I think it's maybe a certain level of cluelessness. Maybe Mr. Deese needs to get in there and say, why don't we delay it until 3:30? I don't know. You know, they've had an eventful 24 hours, particularly with the leakage at the Supreme Court.
I like the idea that you're suggesting they forgot there was a Fed decision around that time, Tom.
Well, you know.
I mean, maybe they did.
We go to the White House dinner, John, and they're like, who are you guys?
Futures up 0.4% on the S&P, on the NASDAQ, up 1/3%. Yields look like this. They come in a couple of basis points, 295.19 on a US 10-year. Big move elsewhere in crude today by 3.5%, 106.03. And finally, Lisa, the EU coming out with what they've been talking about for a long time now, a plan, and I will call it a plan, to ban Russian crude.
Yeah, and we are seeing a reaction in crude, particularly in the Brent market, which is more tied to Europe. You're seeing that surge, but you phrase it well. It is a plan. It isn't a much expected plan. Do they go through with it? And how much will it really change things in the very near term, given some of the dependencies and the tightness in the oil market? All right, today there is a decision. The Fed is deciding, as we've been talking about for the past couple of weeks. This is a big one. And we have been talking about this special that we're doing, and it starts at 1 p.m. Matt Lazzetti of Deutsche Bank, Alan Blinder, former Fed Vice Chair, as well as Priya Misra of TD Securities, all joining us ahead of that news conference at 2:30 p.m. I want to understand the balance sheet. I want to understand how they gauge the reaction in markets to a potential 50 basis point rate hike in this meeting, to potentially some restriction on the the balance sheet side, it has a dueling effect. And how are they planning to view that and see the efficacy? Today, there's a slew of data. April U.S. ADP employment change comes at 8:15 a.m. U.S. March trade data at 8:30 a.m. The excitement here is the trade deficit that seems to be deepening, as well as ISM services data for the month of April at 10 a.m. For the labor market, yesterday that JOLTS data, the job openings data, came in at an unexpected record high of more than 11 million job openings. This means that there is nearly 2 job openings for every unemployed American. How does the Fed deal with that? And at 2 p.m., as you mentioned, John, President Biden is going to compete with the Fed, and he's going to talk about economic growth, jobs, and deficit reduction. I don't agree with Tom. I think it probably is not a complete coincidence in terms of timing. How does he position the strength of the market faced with some of the recessionary concerns and try to push ahead an agenda that gets them to the midterms?
Did you see what Governor Quayle said yesterday in an interview? This was his quote. "We would have been better served to start getting on top of it in September. That was hard to do until there was clarity as to what the leadership going forward of the Fed was going to be." That was from the former governor, Tom, just yesterday. I find that line really, really interesting. A suggestion from a former Fed official that they could have got on top of this in September, and they would have done if they knew what leadership looked like. So maybe this was never about the employment cost index and everything about the fact that he got a second term, and that's when the pivot came.
I'm not going to go there, John, but I will say this.
Well, the former governor is.
Radical change in ex-officer conversation from the days of Alan Greenspan. I can remember Phil Graham, Senator Graham of Texas, going after Alan Greenspan, and Greenspan was just heated. I'm not going to talk about this. I'm not going to talk about that. And nowadays, led by Bill Dudley and people like Mr. Quarles, everybody's talking, John.
And I enjoy it because they tell you what they really think. And when they're in the seat,
for us, it's great.
They don't.
No question about it.
Joining us now, Ben Laidler, global market strategist at eToro, to tell us what he really thinks. Not far from peak Fed fear. Ben Laidler, what makes you think that?
I think we've priced in 3.5% for the terminal Fed funds rate. We've got this sort of double barrel tightening going on of quantitative tightening and the Fed funds rate. I think we're pretty close to sort of peak inflation at 8.5%. I think the market sort of jawbones a tightening of financial conditions, and economic conditions are already sort of weakening. So I'm not sure we're entirely there yet, and I don't think Powell's going to turn all dovish on us, but I do think markets have sort of priced in a lot here. And we're very sensitive to a little bit of loosening of this sort of Fed vice that we've been caught in, right? They've been driving down valuations and driving up recession fears. And I see both of those loosening off a little bit over the next few weeks.
So, Ben, do you think that financial conditions have tightened enough and that stocks have sold off enough to slow the economy enough to get inflation back to a reasonable point for the Fed?
I think we're well on our way, right? Equities are in a correction. Mortgage rates are over 5%. We have real yields for the first time in years. The economy is slowing, not just in the US, but around the world. If there is a silver lining to what's going on in China and what's going on in Europe, it's that the whole world is now clearly slowing. So I think you put all that together, and I think along with, these expectations for this unprecedented sort of double-barreled Fed tightening here, both off the balance sheet and the interest rate. I think enough's been done. And again, I think we're primed for more hawkishness. If we don't get that, again, I see the sort of jaws of this vice loosening off a little bit, and equities trading better than they certainly have done over the last few months.
And that's the broader story. I want to talk about a single name. TK, you've seen this move in Lyft this morning, down 28%. In the pre-market. It's about access to labor and the cost of labor. And I imagine, yes, Lyft has its own unique problems, and Uber maybe shares them, and we'll hear from Uber a little bit later this morning. But Tom, surely that's a signal about the broader issue in the US labor market at the moment.
And to Ben Laidler, I mean, what this comes down to are models, are digital models that are not profit-laden. Is profit all that matters now, Ben Laidler?
It's the only anchor for this market. I mean, just to be grossly simplistic, there's only 2 ways to make money in equities, right? Either valuations go up or earnings go up. Hopefully, they both go up together. But right now, valuations have been falling, and if the Fed stays hawkish, they may continue to fall. So it's all on earnings. And luckily, the big silver lining to all this is corporates remain in very good shape. I mean, despite the sort of headline numbers and some sort of high-profile misses, Earnings are beating expectations on both sides of the Atlantic. Profit margins are near record highs and very resilient. And corporate CEOs are voting with their balance sheets, and they're investing very aggressively. And that's your closest leading indicator to what earnings are going to be in the future.
Ben Laidler of eToro. Ben, great to catch up, buddy, as always. That move is just unreal, Bramo. 28% lower. Uber almost got sucked into some of this, and I think they moved forward their earnings release from later on this afternoon to pre-market. So looking forward to see what they've got to say a little bit later.
To put it into perspective, Lyft shares are down 71% since the record high in March 2019, just to give you a sense of how much has been taken out. But a lot of people are talking about, is this a disproportionate response to the earnings? Were they really that bad, or is it just simply any growth stock that has any miss whatsoever gets absolutely pummeled?
And does it tell you something about the era we're in right now, Bramo? In the previous 10 years, it was about cheap capital, easy for these companies to find funding. It was about cheap labor, easy for these companies to find people to work for them. And right now, that's changed in a big way.
So how do we gauge whether we price that in? That completely changed dynamic of a higher cost of capital and a higher cost of labor. And this, I think, is really a question that underlines what Ben Laidler was saying. Yes, we have seen a lot of repricing. Is it enough to really deal with the moment that we're in? And I don't have a clear answer.
The TK called this, kept coming in late, didn't you, Tom? Could not get a car.
It's just simple as this. You can't get cars because there's no drivers, because they're not making a living. Is there something I said they're not clear?
I think you said everything that needed to be said, Tom. Down 27, down 28% in early trading on Lyft. Futures down 0.4%. Coming up in the next hour. Great lineup today. We'll catch up with Peter Oppenheimer of Goldman Sachs from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Federal Reserve Chair Jerome Powell is poised to unleash the central bank's most aggressive action to battle inflation in decades. Still, investors will be listening to what he says to see if even bigger moves are ahead. Policymakers are expected to raise interest rates by a 0.5 percentage point when their two-day meeting ends today. It would be the largest rate hike in more than 2 decades. The European Union is proposing to ban Russian crude oil over the next 6 months. EC President Ursula von der Leyen also said that refined Russian fuels would be banned by the end of the year. Bloomberg's learned that Hungary and Slovakia won't have to enforce the ban until the end of 2023. Both were opposed to a quick cutoff of Russian oil. In Ohio, a candidate backed by Donald Trump has won the Republican primary for a U.S. Senate seat. Venture capitalist J.D. Vance, once referred to as the former prime minister as unfit, but now embracing him and his views. He defeated 6 other candidates. Trump endorsements will be tested in coming weeks with Republican primaries in a number of states. And Shanghai and Beijing are sticking to their COVID-0 policies no matter what the economic cost is. But Hong Kong is gradually moving towards opening up to the rest of the world. The city is accelerating a plan to ease social distancing rules. Hong Kong is also ending a ban on visits by all non-residents and relaxed some restrictions on inbound flights. And those shares of Lyft are plunging in pre-market trade. If the decline holds, the ride-hailing company could lose a quarter of its market value. Lyft's second quarter outlook disappointed the street. The company's largest rival, Uber, also is falling. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Today, a Bloomberg exclusive. JP Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JP Morgan CEO Summit in London, only on Bloomberg TV and Radio.
So today we will propose to ban all Russian oil from Europe. This will be a complete import ban on all Russian oil, seaborne and pipeline, crude and refined.
The EU has a plan. That was Ursula von der Leyen there, the European Commission president from New York City this morning. Good morning. Futures on this Fed day positive by almost 0.5% on the S&P 500. On the Nasdaq 100, up 0.33%. Yields coming in a couple of basis points on a 10-year, 295.19. On a 10-year, March 16th, we closed that day, the last time the Fed met, 218. That's been the change on a 10-year. The 2-year, if you're interested, closed that day at 194 this morning, pushing 280. Big change, Tom, in this bond market over the last 6 to 8 weeks.
There's no question about it. And again, the change is there, but then there's a change that's not. And it's holding up like a rock, down 12% off of all this from March 16th, John, is Apple. I was stunned to see Apple was $159 a share on March 16th. And it's $159 yesterday.
That's interesting, Tom.
You know, I think that's just one of those tea leaves out there. Can we agree, John, this is a really historic day?
Yeah,
it's
50
really
basis point
cool
move, biggest move going back to 2000, Tom, and maybe another one.
Big deal.
And another one, and perhaps even another one.
And Liz Ann Saunders had the chart out yesterday modeling in 10 rate hikes, which is unimaginable. Always imaginable is Maria Tadeo in Germany and Anne-Marie Horton in Washington today here on the day's events. Anne-Marie, I must go to you first. The president speaking at 2 p.m., getting in the way of the Fed meeting. Why?
He's going to talk about deficit reduction, and speaking to an official, this is what I can tell you he plans to say. Please. A little bit of a preview here. All right, let's read it. He says the deficit reduction is occurring because the robust economic recovery means earnings and incomes are higher, which is increasing revenue, and because the administration is winding down emergency spending. They go on to talk about the fact that the president will also speak to his commitment of reducing the deficit going forward and making critical investments to boost the capacity of the economy, lower costs for American families, prescription drugs, healthcare, et cetera. So it sounds like it is going to be a speech about deficit reduction, but also parlaying that to the president's agenda, which he has only a few months left to try to get passed before the midterm elections.
Hey, John, what's so important here is, as Jan Hatzius has told us, that JOLT survey yesterday, as Lisa mentioned, was jolting.
Yeah.
I mean, that's where we are.
Maybe I'm too close to this, but I just find this absolutely ridiculous that the president scheduled a speech here just after a Fed decision and just before we hear from the Fed chairman. That just, to me, just doesn't sound right. Bramo, you looked at the job openings too. sky high.
What are we going to do, like sports where we show a game?
Yeah, which one has the most precedence? Honestly, it's clear that there is tightness in the labor market. How can you then point to that and see some slack? At the same time, you are seeing a backdrop, John, of rising costs. And I do wonder about oil and how that's going to factor into this discussion that the Fed's going to have.
Well, Maria.
And not only that, but also what President Biden's going to talk about.
I think we've got to get to that, Maria. The oil situation and what the Europeans are set to do. This is a plan. Can you just walk us through the plan? Let's bury all the words, the way they dress it up. Just walk us through the plan, piece by piece, what the Europeans are planning to do.
Well, Jonathan, this new package of sanctions, of course, that would ban Russian oil into the European Union until the end of the year. So it's about 6 to 8 months transition period. What is also key here, Jonathan, and to me is equally important, is that it's not just the oil, it's not just the commodities, everything around it. So insurance, brokerage, a lot of the EU transportation of this oil, all of this will be banned by the end of the year. Now, there's a number of caveats here. This is not going to happen overnight. It is not clear by any means that this is going to lead to an end in this war. If you look at the language coming out of the Russians, they want a big parade come May 9th. The other issue, of course, happening here is, are we going to see price actually go up? And that would be detrimental to what the European Union is looking to do. And then, of course, the other big caveat here is that there will be exemptions for countries like Hungary. Remember, they had said, we're not going to do it if this is detrimental to our economy, and potentially the European Union is going to vow to that and provide an exception until 2023.
Maria, I was struck by the reaction in markets. I can see that oil prices, yes, they're rising a bit, but not that much, considering the fact that people have talked about a possible surge up to $130, $150 a barrel on Brent in response to such a ban. I look at German two-year yields. They're the highest since 2013. Is this causing more harm than it is actually penalizing Russia? Is that the view right now in European populations?
Look, it depends who you ask, and we have seen already, by the way, a de facto reduction. If you look at a country like Germany, it's 35% imports of oil, now gone down to 12%. This is the easy part in many ways. I think when you look at Russia, of course, there's going to be a response to that. They've said it. There will be counter-sanctions for every unfriendly measure that is taken here. But I think for the Europeans, oil will be easy over the short term. I think the big issue here has to do still with gas. And by the way, the German chancellor is speaking behind me, and this is still a big conversation here in this country. How do you unplug and undo this foreign policy of 15 years of appeasement when it comes to Russia?
Maria, thank you. As always, good to catch up. Maria Tadao of Bloomberg over in Germany today, alongside Anne-Marie Hordern down in D.C. We're set to hear from the President of the United States at 2 p.m. Eastern Time, just as we get a 50 basis point hike, coverage potentially from the Federal Reserve, and right before the chairman speaks. Tom, he's often not on time, and I wonder if we get to this weird situation where he speaks a little bit too close to the chairman kicking off his news conference.
To me, it's just clumsy.
It's silly.
You know, it's silly. John, can we make a program note here?
Sure.
Team surveillance is, of course, a vast, vast team, and John Farrell fell off his chair on the weekend, folks, when on the NBC television network, and particularly on USA, there was a small football match of Manchester United. And one of our team members and their offspring, John, featured on NBC, I say, well-behaved children scarred for life.
Well, they are,
by the support of Manchester United.
I can't believe
scarred,
that Joel's done that to them.
It's just harmful.
I cannot believe that Joel's made his kids Manchester United fans.
I mean,
that's a painful experience at the moment, Tom.
It is, although they converse daily with Lord O'Neill, so I guess that works out.
Well, he's depressed too. Very unlikely to get Champions League football this year, and a big overhaul expected this summer.
The one on the right is trouble. Bring the photo up again. On radio, all you need to know is, as usual, the younger offspring is more trouble.
Joel has been our floor manager, Tom, for a while, and I imagine maybe you've done something wrong here, and this is you making up to him. Have you been shouting at the floor manager?
These kids are CAA called. They're destined.
Aren't they? Yeah. They want some talent management.
Yeah.
Okay. Well, thanks for that, Tom.
Yeah, it's good. Man, good to see that on
very,
NBC
very good to see.
As well. John, I'm going to look at this historic day, and I think the Apple says it all, in that there's so many different stories across the market coverage that we call to make one blanket simplistic statement about the markets and where we are with this central bank is just off the mark.
Well, the Federal Reserve set to come through with a massive move, and something we've hardly even talked about over the last couple of months is the fact they're set to do QT as well. So we've got balance sheet reduction release are running potentially at twice the pace it ran at between 2017, 2019 last time around, and that's a big change.
Especially when you put them together. We don't really have a precedent to really understand at this magnitude, and I think a lot of people are trying to grapple with that.
We've got a big conversation coming up. Jamie Dimon, the CEO of JP Morgan Chase, catching up with Bloomberg's Francine Lacqua. She will do that in about 7 minutes' time. Looking forward to that, a timely one. Futures down, up rather, by 0.4%. Just used to saying down a lot over the last couple of months.